no control, right? You have no control and no significant influence. It's more like a passive investment, right? And we always say that the ownership guide is when you own less than 20%, right? Remember that this ownership guide is not the ultimate decider. And of course, you agree with that all debt securities are classified as financial assets. Okay. Then for investment in associates, this is one in which you have significant influence but no control. And the ownership guide is between 20 to 50%. But don't forget that the ultimate decider is if is you having significant influence. So you might have less than 20% if we can demonstrate that you have you if you can have less than 20% equity stake. If it is actually even shown that you have significant influence, it will be classified as investment in associate. JV is when control is shared. Our business combination is when you have complete control. For financial asset, I'm sure you also remember that it can be classified into three. You have amortized cost, you have fair value through profit or loss, and then you have fair value through OCI, right? And then for amortized cost, here you only have debt instruments, and then you have debt instruments. And please note, it doesn't mean that all debt instruments will be in amortized cost, right? But all debt instruments, right, that meets the condition will be in amortized cost. You don't have any equity securities in amortized cost, right? And then the business model is owed to collect. So meaning that these are instruments in which you are actually even holding it for you to collect the contractual cash flow. Remember that debt security are the ones that have stated maturity dates and then have contractual cash flow in terms of principal repayment and then also in terms of interest repayments. In terms of valuation on the income statement, right, what we do is to use the effective interest rate method, right, to get the value of the securities at the initial stage. Then also going forward, right, we use the amortized cost model. In terms of what you see in the income statement for amortized costs, what you have there is the interest income, largely and of course by now you know that your interest income is not the same thing as your coupon payments. Okay, your interest income will only be equals to your coupon if it's a par bond, right? You need to adjust your coupon from the amortization of the bond premium or amortization of the bond discounts if it's not actually even issued at par. I'm sure you all know that one by now. Then for fair value through profit or loss, right? Here in this particular bucket, we can have either debt securities or equity securities, right? So for debt securities, all the debt securities that are held for trading will be in this particular bucket. Don't forget that I said that for amortized costs, right? Those are the ones that you're holding to collect your contractual cash flow. And because you are holding to collect the contractual cash flow, you're not trading on those securities, right? But for debt securities that will be in your fair value through profit or loss are those that you are holding for trading or those that you're holding there to avoid accounting mismatch. For equity securities, all equity securities held for trading must be in the fair value through profit or loss. So something that is obvious is that look, any instrument that is held for trading will be in your what? Your fair value through profit or loss. Okay. So equity security held for trading will be in your fair value through profit or loss. However, for other equities that are not held for trading, probably you want to hold it for a while or you want to sell it. What you have to do is that the standard says that on the day that you're acquiring that particular security, you need to make a decision. Do you want to classify it as fair value through profit or loss or fair value through OCI? Okay, so I'll repeat again. Equity securities, they can broadly be divided into two. The one that are held for trading will be your fair value through profit or loss. The one that are not held for trading, you can make a decision from that day on where to classify it, either fair value through profit or loss or fair value through OCI. But note that that decision is not revocable. Okay, so you can't even reclassify them in the future. Then also, when you have derivative instruments, right, that you are not using to hedge a particular instrument, I'm sure by now you know that for derivative instruments, you can use it either to hedge a particular risk or at times for you to actually even make some money out of it. So any derivative securities that you know you are not using to hedge a particular risk, what you do is to classify it through as fair value through profit or loss. Then for any instrument, any derivative instrument that are using to hedge the risk, of course, if you're using it to hedge a particular risk, that means there is a particular asset or a particular liability that you already have on your books. Whatever that asset is classified, that is where it will be classified. So meaning that, assuming you have an asset that is classified as amortized cost, and you're using a derivative instrument to hedge that particular risk, that particular derivative instrument will also be in what? Amortized cost. Assuming that's fair value through OCI, right? The assets the instrument is hedging the risk, right? It will also be there with it. However, just to emphasize again, for those that you are not using to hedge a particular risk, they will be your fair value through profit or loss. Now, for your fair value through profit or loss, we mark it to market. So that means that on the balance sheet, the value that we see there is the market value or the fair value of that particular instrument. And then the mark to market gain or losses will be in your what? Your income statement. So meaning that your income statement, what you have there is your interest income, your dividend income, your mark to market gain or losses, and realized gain and losses. In terms of fair value through OCI, right? You have you have there in terms of debt securities, right? Your debt securities that you have there, as we always say, that those that you want to hold to collect or sell. What does it mean? It means that these are instruments that you want to hold it, but you want to also have the option of selling it all through during the life of that particular instrument. So in summary, for debt instruments, right, for those that you want to hold all through the life of that particular instrument, it will be in your what? Amortized cost. For those that you are trading, and of course, if you are trading a particular instrument, it's not meant to be in your books for more than 90 days, ideally. Anyway, you shouldn't stay long in your books. That will be in fair value through profit or loss. However, for those in which you want to hold it, you are not actively marketing it, but if there's an opportunity you want to sell it, you can classify them as what? Fair value through OCI. Then for equity instruments, those that are not held for trading, recall that I told you that you can classify it either in what? Fair value through profit or loss, or fair value through what? OCI. Then for fair value for instruments in the fair value through OCI bucket, we mark it to market, meaning that we carry it at the market value, right? And then the mark to market gain or losses are in your OCI. So what you see in your income statement is your interest income, dividend income, right? And then what? That's what you see your interest, and then your realized gain and losses. While those that are unrealized will be in your what? Your OCI. In terms of reclassification of financial assets, remember I mentioned to you that equity investments, equity securities, you can't even reclassify them. Whatever they are, right, at the outset, right, that is where they will be until they actually leave your books. Recall again, for those that are held for trading, will be your fair value through profit or loss. For those that are not held for trading, you can be in your what? Either your fair value through profit or loss or fair value through OCI. But that classification is what? Irrevocable. For debt securities, right? You can for debt securities, right? You can reclassify them. Although is a bit restricted. You can only reclassify them if there is a change in the business model of that particular company. For instance, assume that you're a merchant bank, you are changing to a commercial bank, or you're a microfinance bank, you are becoming a bank or a commercial bank, right? You can say that that is only when you can actually change it, when the business model of the entity changes, right? And of course, because of that, you know that your business model won't be changing all the time. So those reclassification are actually what? Are actually infrequent. Then in terms of what happened, what we do is that we classify them and then we value them prospectively. So meaning that the new classification where it is, the way the way those instruments in that particular new bucket are being classified, are being treated. That's the way that new instrument will be treated. So what do I mean? For instance, assuming you are moving it from fair value amortized cost to fair value through profit or loss, on the day of the reclassification, you first market to market, and thereafter, subsequent to that particular period, you keep on marking it to the market, and then what? So the changes go into your what? In your profit or loss accounts. Now, in terms of investments in associates, remember that for this particular assets, these are the ones in which you have significant influence, but you don't have control. Okay, you can have significant influence, you don't have control. So that means that in most important decision, you can have your say, but ultimately it means that you might not have your way, but you'll be consulted on every important information. And like I mentioned earlier, the guidance, if your ownership percentage is between 20% and 50%, please note, I use the word guide. So meaning that you can have 5% and it will be what? Investment in associates if you can demonstrate influence. And it's possible for you to even have 100% of a particular company. If you have 100% and you don't have control, and what we can deduce is that, look, what you have is only significant influence. We'll classify it as investment in associates, right? However, in your exam, note that if you are not given any other information and you are only given the ownership percentage, treat it as what? Investment in associates. Now, there are some other things that can reflect significant influence, even when your percentage ownership is less than 20%, right? Let's look at some of them. For instance, if you are represented on the board of directors, right? If you are represented on the board of directors, it means that for every important decision, the board will be consulted, and indirectly you have your say in those decisions. So that gives you significant influence. And then when you have material transactions between the investor and the investee company, okay, those material transactions can also show you a bit of a significant influence, particularly if those transactions are not at arm's length, okay, when some concessions are actually even given. Assuming that also that the investor company have a significant participation in the policy making process of the investing company, definitely that shows that you have significant influence. And of course, when you have interchange of managerial personnel, for instance, if you are seconding somebody from the investor company to the investing company, or you are bringing somebody from the investing company to investor company, either to understudy and even understand some other things a bit better. Then, of course, when you have technology dependency, particularly when the investing company is depending on the investor company. Now, in terms of accounting for investments in associates, right? There are two methods that we use. You can use the equity method, or you can use the fair value method, right? For the fair value method, under IFRS, it is highly restrictive, meaning that it is only a few investment management companies, such that venture capital company, mutual uh, mutual funds, right? Unit trusts and investment-linked insurance company. Those are just the few companies that are allowed to use the fair value method under what? IFRS. But under US GAAP, any company can use either fair value method or equity method. And please note, your method, your option is irrevocable. So meaning that once you've adopted a particular option, you have to continue with that particular route. Now, for the equity method, another name for the equity method is what we call one-line consolidation. So mean that in your income statement, you only see a line, income from associates, and then in your balance sheet, what you see is what? A line with showing investments in associates. Now, so let's talk about the equity method. Okay. So in terms of the equity method, right? Another name for it, like I mentioned earlier, is one-line consolidation. And what we do here is that to record on the balance sheet, what you do is that on the day that the investment is made, you record a line called investment in associate. And what you have there is simply the fair value or the amount that you've paid for that particular investment. Subsequently, that particular value can increase or reduce. What are the adjustments that are made subsequently? Subsequently, the your investment in associate, the amount that you've paid, it is adjusted by your share of the investee company's income or in invested companies either profit or loss. Because of course, when you own a particular stake in a company, you have as you also are entitled to the share of that particular company's income, and they are responsible for either percentage of that particular company's loss. So if you have a 20% stake in a particular company, meaning that all their profits, you are entitled to 20% of it, and then you also have claim or not the 20% loss if they actually even recorded the loss. So the investment is adjusted for the share of income or loss. Of course, know that that income or loss will be recorded in the what? In the income statements. Now, in terms of dividend or distribution from the investing company, we treat it as return of capital and we use it to reduce the amount that you have on the what? On the balance sheet as investment in associate. So I'm sure that you can also see a difference here. Recall that under financial assets, your dividend income goes to the income statement, but under investment in associate, it doesn't go to the income statement. We use it to reduce the value of your investment in associates in the income statement. And then somebody might be thinking that what happened, assuming that the company have made losses and completely erode the the your share of the profits, right? Your investment in associates. The standard says that you will be that you need to suspend investment in associates, recording it. But however, all the losses the accumulated losses, keep it somewhere. When they start making losses, first use so when they stop making losses and they start making profits, use your share of profits to eliminate all the accumulated losses. Then once you've accumulated the accumulated losses, then you can now resume recording investment in what? In associate. Please, like I mentioned earlier, if you have question or something is not clear, feel free to drop your questions or your concern in the chat room, and then I will go there and periodically address those questions. Okay, now when you have at times also what you realize is that your share, the amount that you are paying for investments in associates, okay, the amount that you're paying for investments in associates, ideally, right, should actually be the share of the net asset of that particular company. So meaning that assuming that you're buying 25% of a particular company, it should be 25% of the net asset, which is asset less liability, right? Ideally, that's what you're paying for. But oftentimes you realize that the amount that has been paid is higher than the book value of that company's net assets. So you can have the company that the book value is, let's say, 100 million, but you're actually paying 40 million for a 25% stake, right? So that means that you are paying 15% excess on that particular book value, on the book value of that particular company. Now, what are the conditions that can lead to you paying excess paying above the book value? There are two things that can cause it. One, if the fair value of the assets of the company is higher than the book value of the asset of the company. Because remember that book value is typically based on historical cost. However, assuming that something has happened and the fair value of the asset has actually increased, you can have a situation in which the fair value of the asset is higher than the book value of that particular asset. Of course, when the person wants to sell the company to you, in determining how much you will pay, you won't be using the book value. The focus will be on on the fair value. Then at times also, if a company is doing well, you need to give the owners of that particular company incentives to sell, right? And because of that, you might need to pay even above the fair value of the assets of that particular company. And that is what we call goodwill. And goodwill is simply the premium that you pay above the fair value of the company's asset. Fair value of the company's assets. Okay? Now, when you are recording investment in associate, it is very important for you to determine what is the cost of that excess purchase price. Of course, the excess purchase price is the amount that you are paying above the book value of that particular company. Either is because the fair value of the company is higher than the fair value of the company's assets is higher than the book value of the company's assets, or it is because of goodwill. Why is it important? Because it will affect what happens subsequent to that particular period. What do I mean? For instance, whenever the difference is caused by the fair value being higher than the book value, we need to amortize that difference over the life of that particular asset. And what we typically do is to mirror what is being done on the underlying asset itself. So for instance, assuming that you have the asset that is being depreciated over, let's say, 10 years, that excess purchase price, that difference between the fair value and the book value will also be amortized over the same period. Okay? using the same method that's used for that particular depreciation, right? And then assuming that is a goodwill, goodwill will be tested for impairments periodically. And if there is an impairment, it will be adjust the book value of that particular investment will actually be adjusted appropriately. Now, I haven't talked about goodwill. How do you test for goodwill in investments and associates? Okay. The IFRS method is slightly different for what we do under US GAAP. So under IFRS, right? You can actually even test, you must test for impairment really, if there are evidence that look, there might be some some losses on the future cash flow of that particular company, meaning that if the cash flow of the company will be lower than what has been expected, particularly if you can estimate that particular loss objectively. Okay. Now, and what we do under IFRS is to compare the carrying value, right, with the recoverable amount. Of course, you remember that the recoverable amount is the higher of the fair value less cost to sell or value in use. Okay, so you compare the carrying value with the recoverable amount. If the carrying value is higher than the recoverable amount, we'll say that look, that asset is impaired, and that the level of the impairment is the difference between the carrying value and the recoverable amount, and these will be expensed in the income statement. And of course, we need to write down the carrying value to the recoverable amount. Now, under IFRS, if the value of that, if the recoverable amount increases in future, you can now also you can write up the particular asset. However, it is only up to the extent where it was before. So mean that you can only reverse the impairment loss that you've recorded before. You can't actually even write it above what it was before. So for instance, assuming that the value was 50 million before, right? So you wrote it down to 35. If something happened, right, that the recoverable amount has moved from 35 to, let's even say, 75, you can only write it up to 50 because that was the amount that it was before. For US GAAP, right, the standard says that you write it down if there is a change, if there's a decline in the fair value, and that decline is determined to be permanent. Okay, then you need to write it down to this the fair value. Okay, and then under US GAAP, right, the asset once written down, it cannot be written or it cannot be actually be written up also. Then of course you recall that whenever there are transactions between the investor and the investing company and the profit is not confirmed either by use or by sale to a third party, we need to adjust for that particular unconfirmed profit in the words income from associates. So from all these things, you will see that now I've talked about what you see in the balance sheet. On the income side, what you have there, you have your share of the associates profit. Then you need to add, you might, if you have excess purchase price that you're amortizing, you adjust it for it. If you have goodwill impairment, you adjust it for it, right? And then also if you have unconfirmed profit, you also adjust it for it in the what? In your income from associate. And of course, you know that your income associate from associate is also called what? Equity income, which is named after the method that we are using here. Now, let's talk about business combination, okay? And this is where you have control over the investing company. And the standard says that once you have control, right, you need to prepare what we call a group account. So a group account is a consolidation of all the entities that you have control over. So you consolidate the balance sheet, you consolidate the income statement of all the entities that you have control over. So you prefer a balance sheet showing all the entities where you have control over. Now, what is the step to preparing a consolidated account in terms of the balance sheets? For the balance sheets, the first thing you do is to get the fair value of the assets and liabilities of the invested company, right? Remember that oftentimes, okay, cool. Now, so okay, I get your question. In terms of, please, for goodwill, so for goodwill impairments, excuse me, under under US GAAP, you can't write it back up. Okay, but under IFRS, you can write it back up. So for instance, let me take that example again. Remember I said that the example under IFRS, the carrying value was 50 million, right? But the recoverable amount reduced to what? 35 million. We wrote it down to 35 million, okay? And then that difference of 15 million, we actually even recorded it in the income from associates, right? We expensed it there. Now, let's assume that subsequent to that particular period, the value went up from 35 to, let's say, 75. We can only write it back up to 50, which is the amount, the value that it was before the impairment. Now, let's assume that the same thing applies let's assume that the company is actually using US GAAP, okay? The carrying value was 50, and then let's assume that the fair value now, they don't call it recoverable amounts under in US GAAP. Please note that one, right? You only use recoverable amount under IFRS. Assuming that the fair value now is 35. And here, at that particular point in time, we assume that that decline is deemed to be permanent. Of course, we'll pay it, and then we will expense the 15 million as impairment and goodwill impairment charge. Let's assume that subsequently, right, although we thought that that decline is going to be permanent, but we had good news and the value has increased to 75 million. You know that under US GAAP, also under IFRS, you can write it up to 50, but under US GAAP, you can't write it back up. Once you've written it down, you continue carrying it at what? At 35. Okay, good. I hope that is clear. Now, back to business combination. Like I mentioned, for the balance sheet, on the day of the acquisition, the first thing is to get the fair value of the assets and liabilities of the subsidiary. Okay, of the subsidiary. You're welcome. Of the subsidiaries, right? And even oftentimes there might be some assets and liabilities that are not even recognized based on accounting standard, but because you want to acquire them, you need to bring all of them into the books. Okay, and then what you now do, right, is to now have the balance sheet of the subsidiary using the fair value of the asset and the liability. Please note, what you use for consolidation of the subsidiary is the fair value of the assets and liability and not the book value. Please note for the investing company. Okay, we're talking about the investing company. So after getting the value of the investing company, then you compute goodwill. We'll talk about how goodwill is computed very soon. Okay, we'll talk about that one very soon. The next thing also is to adjust for okay, Tolu, I'll still come back to your question on amortized costs very soon. Okay, let me just finish this slide and I'll come back to that. Right. So the next thing to do is to adjust for acquisition costs. Remember that your acquisition cost, when you acquire a company, you can either pay cash or you can issue your own shares, right, as payment for that particular transaction. And it's possible for you to have both, the combination of both cash and the shares. So what you need to do is to adjust for those for the acquisition cost. So meaning that, assuming that it's a cash, you need to deduct the cash from the entity's cash. And if it's shares, you need to adjust your shareholders form appropriately. Right. Then also, if you don't have 100% control, then you have what we call non-controlling interest or minority interests. Okay, and that also needs to be prepared. That also needs to be computed. So now, having done this, the next thing to do is to prepare the consolidated balance sheet. And to prepare the consolidated balance sheet, what you do is that you take the value of each item, each asset of the parents, you add it to the fair value. Remember, we said that we are using fair value, the fair value of the subsidiary, okay, of the investing company for each item. You add it. You do the same thing for assets, you do the same thing for liability. And of course, on the asset side, you need to also include your goodwill that you've computed. Now, assuming that you have less than 100% stake, you need to have a line in your equity called minority interest or investment in subsidiary. Because think about it. We've added 100% of the assets, we've added 100% of the liabilities. But assuming that we only have 70%, that means that the equity, the account will balance, right? Conceptually, because we only have 70%. Then that 30%, we need to actually even create something called non-controlling interest. We'll talk about how we compute non-controlling interest very soon. Now, what happened to the income statement? What you do is that the revenue of the parent, revenue of the subsidiary, you add it together. Please, before I even get to that, now something else that you also need to also do when you are consolidating balance sheet is that you do the same thing for that, for the asset, for the balance sheet and also the income statement. Please note, when you are preparing your consolidated financial statements, right, or the group accounts, all intercompany transactions are eliminated because it's not possible for you to transact with yourself and even make profit. So all intercompany transactions are eliminated. So for instance, assuming the parent has sold goods to the subsidiary and then the subsidiary is owing him. So remember that somebody will have account receivables, the other one will have accounts payable. All those ones will be eliminated. All those intercompany transactions will be eliminated. Ditto for the income statement. Assuming the parent sold something to the subsidiary, the parents will have the revenue, while the cost of sale will be in the subsidiary. All those ones will be eliminated. Okay, so impairing the income statements, we had the revenue of both parent and the subsidiary. We had up all the expenses of both the parents and the subsidiary. Of course, we eliminate all intercompany transaction. Now, then we have the potential profit for both the group and the non-controlling interest. Now, assuming that you have non-controlling interest, using my former example, assuming that we own 70%, we're going to take 30% of the profit that the subsidiary recorded and use it to compute non-controlling interest in the income statement. So what do I mean? So for instance, let's assume that at the profit level, the parents recorded 300 million, the subsidiary recorded 100 million. Okay. Of course, when you're adding the income revenue and the expenses, you see that the potential profit will be what? 400 because you're adding both of them. But recall that that 400 belongs to the parents and also the minority interest. Assuming that the parents owns only 70%. So we need to take 70% of the 100 million that the subsidiary recorded, which is 30 million, as the what? Non-controlling interest of the profit. And then we deduct it from the overall profit to get the group's profits. Okay? That minority interest that we've deducted, that one goes to what? It goes into the non-controlling interest in the balance sheet. Recall that at the end of the period, your profit after tax goes to the retained earnings, right? Same thing happened here, but the one that goes to the retained earning is the share of the parents, while that of the minority interest goes to the minority interest section on the what? On the equity, the one that we computed before. So using my example, remember out of the 400, 30 million will belongs to the what? The subsidy, non-controlling interest, while 370, 300 of the parents and 70% of the subsidiary belongs to the parents. So 370 goes to the retained earnings, while 30 million will be added to the non-controlling interest in your equities. Okay? Now, so briefly, let's talk a bit about goodwill, right? In terms of goodwill, there are two methods to use. We have the full goodwill method and we have the partial goodwill method. The full goodwill method, is the only method allowed for the computation of goodwill under US GAAP. And that is why oftentimes it is called the US GAAP approach, right? However, for partial goodwill, right, partial goodwill is not allowed under US GAAP. So at times, some people call it the IFRS approach. Although IFRS allow both the full goodwill and then the what? And then the partial goodwill method. Okay? You can use either under IFRS, right? But under US GAAP, it is only the full goodwill approach that you use. Now, what is the difference between the two? Under the full goodwill approach, what we do is that you get the fair value of the subsidiary, okay? The full value of that particular company. And then you also get the full value, the fair value of the company's net assets. Of course, you know that the difference is there. So for instance, let's assume that the company is listed. You can use the share price multiplied by the number of shares to get the fair value of the company. If it's not listed, of course, you've done a lot of things in equities for you to get the value of that particular company. Then the excess of the fair value of the company above the fair value of the net assets is the what? The goodwill under the full goodwill method. Right? Now, for the partial goodwill method, what we do is the amount that you are paying, right? The excess of the amount that you are paying above the firm's proportionate share of the company's net assets. So for instance, assuming that you're acquiring 70%, right? what is the amount that you are paying, and then what is 70% of the net assets. That is what we have. That is the goodwill under the what? The partial goodwill approach. Okay, right. Now I mentioned non-controlling interest. The next question is, how do you determine non-controlling interests? Now, the method that you use in computing goodwill is the method that is the one that determines the method that you use in computing non-controlling interests. So in the non-controlling interest or minority interest, we also have the full goodwill approach. We also have the partial goodwill approach. If you use the full goodwill to calculate goodwill, you must also use the full goodwill approach to compute the what? The minority interest. And then if you use the partial goodwill approach for goodwill computation, you must also use same under the what? The minority interest. So under the full goodwill approach, right? Under minority interest is the minority interest percentage, the minority interest stake or percentage, right? As a proportion of the company's fair value. So let's assume that the company's value is $1 million and you're acquiring 70%. So that means that, look, the minority interest is 30%. It will be 30% multiplied by $1 million, which is what? $300,000. Okay? Now, for the partial goodwill approach for computing minority interest, right? We use the minority interest percentage multiplied by the identifiable net assets, right? Of that particular company, fair value of the identifiable net assets. So let's assume that in this example, right, the fair value of the company's assets is what? Is $700,000, right? The minority interest will be 30% of what? $700,000, which is 210,000. Okay, so that is the how we compute goodwill. Okay, now so let's even now look at the differences between the full goodwill and the partial goodwill. Of course, I've mentioned how it is computed, but it has significant implication for the performance of the company and also the performance ratio. Now, from what I've described, you agree with me that oftentimes, right, the full goodwill is typically higher than the partial goodwill. Now, let me also mention this, right? Oftentimes, of course, if the acquisition is 100%, even if it's under IFRS, note that you are effectively going to use the full goodwill approach. So meaning that the partial goodwill approach will only be applicable under IFRS if you acquire less than what? 100%. But please note, if you acquire less than 100%, right, you see that the full goodwill will be different from the partial goodwill in computing in that particular acquisition. Okay. And like I mentioned also, the method of computing non-controlling interest or minority interest will be the same as what we use in computing goodwill, right? If goodwill is used for goodwill, I think I've mentioned that one also. Okay. Similarly, you also agree with me that the non-controlling interest will be higher when we use the full goodwill approach compared to when we use the partial goodwill approach. Now, from what I've described earlier on the computation of the non-controlling interest in the income statement, you will see that it's the same method that we use. Either you are using full goodwill or partial goodwill in the income statement. There's no differentiation between the two of them. So ultimately, you see that full goodwill will result in you having bigger assets because full goodwill is higher than partial goodwill. And because of that, right, and you also agree with me that the net income will be the same, either you use full goodwill or partial goodwill. So you notice that whenever you use full goodwill approach, your ROA is going to be lower compared to when you use the partial goodwill. Same thing also, when you have minority interest, right, your equities, shareholders fund is going to be higher when you're using full goodwill compared to partial goodwill. And because of that, you see that under full goodwill, your ROE will also be what? Will also be lower. Okay? Right? Under the full goodwill. Okay, so let me just check. I think I can see some question here. Okay. Right. So, okay. You said I should take the full goodwill and the partial goodwill approach. Okay. For TY, right? I guess you are talking, okay, for NCI, non-controlling interest. Okay, fantastic. Right. So now let's put examples to it. By the example I made, now let me first tell you that for full goodwill under minority interest, you use the minority interest percentage multiplied by the fair value of the company. Please note, under this goodwill, something that you must be clear about, that you must not mix up, is the fair value of the company. You should know that it's different from the fair value of the company's net assets. So the fair value of the company net asset is the fair value of the assets less the fair value of the liabilities. That's the fair value of the net asset. But when you are looking at the fair value of the company, is the valuation of the company. Of course, you remember from level 1 that there are some economic assets that we don't have on the books that we consider when you are valuing companies. So oftentimes, right, you notice that the fair value of the company is always higher than the fair value of the company's net assets. Having said that, for the full goodwill approach of NCI, is NCI percentage multiplied by the fair value of the company. And the example I gave, assuming that we have a company that the fair value of the company is $1 million, the NCI percentage is 30%. The non-controlling interest under full goodwill approach should be what? Will be 30% multiplied by $1 million, which is what? $300,000. Now, for partial goodwill approach under NCI, it should be NCI percentage multiplied by the fair value of the identifiable net assets. Let's assume that the fair value of the identifiable net assets here is what? $700,000. Since you control 30%, since the minority interest is 30%, it will be 30% multiplied by that $700,000, which will give us something like $210,000. Okay? I hope I've answered your question, CY. Okay? Let me check. I think there are other questions in the thing should come up. Okay, fantastic. Yeah, let me try and even check. Okay, I've taken that one. Yes. I noticed that from NCI percentage is yes. So Neka, please note under for the income statement, your NCI is the same, either you're using full goodwill or this or partial goodwill, and it's the NCI percentage of the what do you call it, of the subsidiaries PAT, not that of the group. Okay, so he said, is it the same thing as the percentage of fair value? Of course, NCI is the same thing as NCI percentage. Yes, you are right. It's the same thing, NECA. Okay. Yeah, I think I've taken NCI in the income statement. But I think I've taken NCI in the income statement, which I said is the NCI percentage multiplied by the subsidiaries PAT. Okay. So don't worry, Tolu, I will still come back to your question. Right. Cool. Okay, right. Talked about this. So let's talk a bit about goodwill impairments, right? Goodwill impairments. The standard says that we must test goodwill for impairments at least once annually, right? Then something that you need to know is that, look, we test goodwill for impairments as either we call the cash generating unit or reporting units level. What does it mean by that? It just means at the divisional level. Because if you look at an organization comprises various divisions. For example, if I have a manufacturing company, I have the manufacturing division, I have the distribution division, I can have the administrative division. So at that reporting unit level or that division level, that is when we test for goodwill. So the implication of that also is that whenever you have goodwill, you need to allocate the goodwill to each of those divisions. Because ultimately, the truth is that, right, before you even know the goodwill that you pay, remember that we said that goodwill is the premium that you are paying above the fair value of the company's net assets. You need to determine the benefit that you generate from each division. It is the addition of the benefit you generate from each division that will determine how much you will ultimately pay as a premium for the whole entity. Okay? So it is started at the division level. So now, however, the way we test goodwill for impairments under IFRS is slightly different from how we test it under US GAAP. Under IFRS is a single step approach. And please note, under IFRS, we call it at that division level, we call it cash generating units. So whenever you see a question that mentions cash generating units, even if you are not told if it's US GAAP or IFRS, note that you're dealing with an IFRS question. Okay, once you see cash generating generating units. And now, how do we test for impairment under IFRS? We compare the carrying value of the cash generating units with the recoverable amount. Remember that the recoverable amount is the higher of the fair value less cost to sell and the value in use. So whatever the carrying value is higher than the recoverable amount, that difference, right, is actually what? The impairment loss. So we need to write it down to recoverable amount, and we need to, that difference is the impairment loss that will enter the income statement. And of course, we expense it in the income statement. And how do we treat it? So whatever you have that write down, the that loss, we use it to write down the goodwill. And often time it's possible that the difference between the carrying value of the cash generating unit and the recoverable amount, it might even be higher than the goodwill. So for instance, assuming that the goodwill is 300, you could see that the amount, the difference between the carrying value and the recoverable amount can be up to 500,000, right? And then what you have as goodwill is 300,000. So when you have that particular situation, what you do is to fully write up the goodwill. And that difference between the amount that you're writing down, which is 500,000, and the carrying and the goodwill, which is 200. Here the difference here is 200,000. You deduct it, you prorate that loss, you share that loss among all the other non-cash assets for that cash generating unit on a pro rata basis. Okay, that's for IFRS. For US GAAP, we have a two-step approach for goodwill impairment testing. We have what we call the recoverability test. We first conduct the recoverability test, right? And then if it shows us that the assets, the goodwill is impaired, then we now go into loss measurements. So meaning that for the recoverability test, what we are trying to do to answer the question, is the goodwill impaired? If the answer is yes, that's when we now proceed for the loss measurements. So for the recoverability step, the first thing we do is to compare the carrying value of the reporting unit with the fair value of the reporting unit. If the carrying value is lower than the fair value of the reporting unit, that means it's not impaired. We don't proceed. Okay, we don't do any loss measurements because, of course, the carrying value shouldn't be higher than the fair value. However, if the carrying value is higher than the fair value, then we can say that there is an impairment, and that difference will now go up, now proceed and do loss measurements. What is the loss measurements? We compare the carrying value of the goodwill, and with the implied fair value of the goodwill. What do we mean by that? It means that based on the new condition that you have now, you now compute the goodwill again. Remember that here this is US GAAP. Under US GAAP, we're using the full goodwill approach. And under the full goodwill approach, what are you doing? We are comparing the fair value of the company's valuation, right? The fair value of the company with the fair value of the net assets. And the difference between the fair value of the company and the fair value of the company's net asset is the goodwill. So now we compare what is the fair value of the company and then the fair value of the company's net asset to get the implied goodwill using the condition now. Once we get the implied goodwill, we now compare it with the carrying value of the goodwill. If the implied fair value of the goodwill is lower than the carrying value of the goodwill, then you now write it down to the implied value of the goodwill. So for instance, assuming that the goodwill, the carrying value is 300,000 and the implied value is actually 100,000. So we write it down to 100,000. Okay, and then we expense that difference into the in the income statement as impairment loss. Okay. Right. So let me go back to Tolu, your question on financial assets. Okay. So let me just quickly read your question well so that I can get it well. So Tolu, you said amortized costs and mark to mark. Okay, cool. Right. For amortized costs, what we do, how do we value for amortized costs, right? What we do is that we actually use the effective interest rate method. And what is the effective interest rate method? What does it mean? It simply means you discount all the cash flows expected from that securities, right? Using the prevailing interest rates when that particular instrument was issued. Simply put, remember what you learn in fixed income, how you value a bond, right? You get all the cash flow and you discount it. Exactly that is what we do. But under IFRS, we call it effective interest rate method. However, please note that the discount rate that you're using is the discount rate when the bond was issued. So meaning that 1 year from now, when I'm valuing these securities, I will also value the remaining cash flow. Of course, I will have collected, as well as an advertising bond, I would have collected the coupon and also some part of the principal. However, I'm still using the interest rate, the prevailing yield when the bond was issued. I will use that method to value that instrument all through the life of that particular instrument. Okay. Then for fair value through profit or loss or fair value through OCI, like I said, you mark those ones to market. Okay. And then if it's fair value through profit or loss, the mark to market gain or losses goes into the income statement. And if it's fair value through OCI, that difference goes into your what? Your OCI. Okay. Tolu, I hope you are fine now. I can let me know if you still have some other questions. Okay. So let's look at a summary comparing the equity method and the what acquisition method. So here we are assuming that, remember I told you earlier that if you have over 50%, doesn't mean that automatically you are going to use acquisition method. It doesn't ultimately mean that you have control. You can have 100% and then you can just have significant influence. So let's assume that you are looking at here, assuming that you have percentage that ideally should actually even qualify you for control, but you only have significant influence. The question is, what will be the difference? Assuming that you've used the equity method and the acquisition method. So for your revenue, the acquisition method is going to be higher because you're adding the revenue 100%. For operating profit, the operating profit will be higher under acquisition method because of what? Your equity income, right? Which is your income from associates, right? And all those adjustments. It is a non-operating income item. So it's not a part of your operating income. Okay. However, note that your net income will be the same. Because remember, it's almost the same thing. And remember, I told you that you're going to deduct, under the acquisition method, you are deducting the share of non-controlling interest. So it gives you the same amount in your net income. Total asset is going to be higher under acquisition. Liability will also be higher under acquisition. Because remember that you're adding the subsidiaries, assets, and liabilities. In terms of equity, equity should ideally be the same. But should ideally be the same. However, if you have non-controlling interest, it will be higher under acquisition method. Your net profit margin, right, will actually even be higher under the equity method, right, but lower under the acquisition method. ROE and ROE will also be lower under acquisition method because remember that you will have for the equity you have non-controlling interest, right? All right, and then also the asset is actually larger. But please note, assuming that you do have non-controlling interest, ROE will be the same. Either you are using acquisition method or equity method. Of course, there's no minority interest under the what? Under the equity method. Okay. Okay, good. So Isaac, let me just take the impairments under US GAAP. So under US GAAP, there are two steps. Okay. The first thing is to conduct that recoverability test. And the worst way to think about it is this. That recoverability test is asking, is this asset impaired? Is the asset impaired? If the answer is yes, you can see that it is impaired. Then you now proceed to do your loss measurements. If the answer is no, it is not impaired, then you don't need to proceed and do any loss measurements. You leave your goodwill the way it is. So what do we do under recoverability tests? We compare the carrying value of the reporting unit with the fair value of the reporting unit. Please note, under US GAAP, they use the word reporting unit. So whenever you have a question that they are talking about reporting units, not automatically that you're talking about a US GAAP company, and then it's the US GAAP approach that you need to apply. Okay? So like I said, the recoverability test, you are comparing the fair value of the reporting unit with the fair value of the reporting unit. Whenever the carrying value of the reporting unit is higher than the fair value of the reporting unit, that means that it's saying that, yes, the asset is impaired. Go and do loss measurements. However, if the fair value is already higher than the carrying value, that means the carrying value is even lower. It's not impaired. You are not even overstating it. So there is no loss measurement. Now, the next question is, what do we do on loss measurements? Basically, what we are saying here is that the goodwill that you are carrying, the carrying value of the goodwill, compare it with what should have been the goodwill, assuming you are computing the goodwill today. So based on the information that we have today, what should have been the goodwill? Let's now compare it to the carrying value of the goodwill. Now, the question now is, what should have been the goodwill today? Don't forget that under US GAAP, we're using the full goodwill method. And how do we do the full goodwill method? We compare the fair value of the company with the fair value of the company's net assets. Given that we are working at the reporting unit level, we'll compare the fair value of the reporting unit with the carrying value of the reporting unit's net assets. That difference between the fair value of the reporting unit and the fair value of the reporting unit's net assets will give us the what? The implied goodwill. So assuming that based on today's information, let's assume that the company is worth on, the reporting unit is worth $100,000, right? And then the implied goodwill is what? $80,000. So that means that look, there's a difference. The implied goodwill is, so let's assume that the implied goodwill was 80,000, carrying value is 100,000. So that means there is what? There's a loss of what? Of 20,000. And what do? We actually even expense it in the income statements. Okay, good. So Isaac, I hope you are clear. Now, Baba Tokpe, now let me take that again in terms of ROA and ROE. Please note, for assuming there is no minority interest, ROE be the same. It's ROE that will be the same if there is no minority interest. However, ROA will not be the same. Because remember that under the acquisition method, we've added the assets of the subsidiary, but we've not done same under the equity method. So ROA will always be different, but ROE will be similar if we don't have minority interests. Okay? No, we have minority interest. Okay, fantastic. Okay, right. So let's quickly let's quickly run to employee compensation. Okay, I think there's another question. Okay, fantastic. Welcome, Babatokbe. Right. So let's look at employee compensation. So there are different types of employee compensation, and in your curriculum, classify them into 5. The first one is the short-term benefits, the one in which you actually even get. In terms you expect, these are the ones that you're expected to get within what? 12 months. And they include your wages and salaries, annual bonus, non-monetary benefits such as Medicare, right? Your social security, all those ones are your short-term compensation. Long-term compensation are those that you actually qualify and you collect it after a year. For you to even qualify for it, you must work for more than a year. So, for instance, assuming you have sabbatical, some organization have if you work for them for 7 years, you can actually take a year to actually even work or even rest. Some you must rest, or you can even take call it long-term paid leave, right? So that one is the most common in some the academics, really. And then you can also have long-term disability benefits. So there's some companies that they tell you after you work for a year, for a particular number of years, if anything happens to you, we're going to take care of it. The terminal benefits, whatever we pay to employees, whenever we want to terminate their appointments. So that's actually, we can call it redundancy, or we don't need your service again. We're doing some restructuring. And because we are the one telling you we need to actually compensate you. So that compensation is what we call terminal benefit, and includes your severance pay. Some will give you access to Medicare, and some will even give you career counseling so that you can even get another job. All those ones are your terminal benefits. Then we also have share-based compensation. And these are compensation that are based on shares or in reference to shares. So meaning that these are compensation that you are paid either in shares or in reference to shares. So that means that you either get shares for it, or the monetary value that you get, it is tied to the value of the shares. Of course, you have the restricted stuff, you need the RSUs, stock option. We'll talk about that one very soon. Then, of course, you have post-employment benefits, which is your pension. Some will give you life assurance, and some will give you Medicare. Okay, right. Now, for employee compensation, right, there are 3 important dates that are very important. 3 very important dates that are very crucial. The first one is the grant date. So the grant date is the day that that compensation is complete, it is communicated with the employee and the employee accepts them. Okay, that's the grant date, right? Please note, oftentimes we get the value of that compensation on the grant day, and because that one can be tricky, particularly when you get to share-based compensation. That value, of course, know that the value of shares can be highly volatile. The value of that compensation is the value on the grant date. The vesting period is the period in which the employee earns, quote and unquote, right, qualifies for that particular compensation. So, for instance, assuming that you have a share-based compensation that says that you must work for 3 years for you to be able to be eligible to get those shares. Okay. So that 3 years is your what? Is the vesting periods. And typically what we do is that, look, since you are working over that vesting period to earn it, we spread that compensation over the what? The vesting period. So assuming that you are trying to get the it's even the share-based compensation, you get the value of the shares on the grant date. Okay. That value, you share it over the vesting period. Then on the settlement date, the employee will get that particular benefit. Okay, good. Although, remember, please note, you get it on the settlement date, but the company expense it over the what? The vesting, over the vesting period. Right. Now, for short-term benefits that we mentioned earlier, what you see is that the vesting period, like I mentioned, is typically days, maximum of weeks. And oftentimes the form of payment is actually cash. So what we record is the undiscounted salary or wages of that particular employee, undiscounted cash, all discounted cash that the economy will actually, the employee will get. That is what we expense. And of course, we amortize it over the vesting period. In terms of share-based compensation, right? The vesting period takes years. The form of payment is shares, and then what? The fair value of the shares, right? Based on the value on the grant date. This is what we use to value the shares of that particular company. Okay. Then for post-employee benefits or pensions, right? Those won't take years or decades. It can either be cash or benefits, and then the amount recognized is the present value of the estimated future benefit. Talk a bit about that among them. So let's talk a bit about share-based compensation. Okay. Now, share-based compensation is very important, particularly for relatively small companies. We'll talk about it very soon. So, what are the advantages and disadvantages of share-based compensation? Number one, it helps to align the interests of the management with that of the shareholders. At times, the shareholders might be thinking one way. And remember, if the owners or if the managers of the companies are not owners of the company, right, they might actually be doing things that can actually even be injurious to the shareholders. So it helps to bring their interests together, right? And of course, I'm sure you've learned under corporate issues the typical principal agent conflict. So share-based compensation is a way of avoiding that by bringing the interest, causing an alignment between the interest of the management and that of the shareholders. Now, company also have overlapping vesting period, and that help with staff retention. So what do we mean? For instance, assuming that you are given share-based compensation with 3 years vesting period, at the end of the second year or at the end of the first year, you might be given another share-based compensation with another 3 years. So meaning that at a particular point in time, you have, at times you can even have up to 3 sets of share-based compensation which overlapping vesting period. So you can't say that after collecting this one, I'm running away, right? After collecting this one, you still have another one that is yet to vest. So that helps staff retention. Then also, the beauty of share-based compensation is that there is no direct cash outflow from the company, please, which helps the company to preserve liquidity. Please note, it doesn't mean that share-based compensation doesn't have cost implication. It just means that the company is not parting with cash. Okay, although there are some implicit costs, right? And this is very important for very small organizations or startups that can't even pay significantly. So to attract and retain talents, they can give them share-based compensation. And they know that once they can work well and this company is more valuable, their own shares that once they invest and you have it, the value of that shares will also be significant. So they use it to attract and retain talent. Now, what are the disadvantages of share-based compensation? One, it's true that although employee can try, but the truth at times is that, look, there are some times that oftentimes what determines shares is more than the performance of the employees. It's more than the profitability of that particular company. So some will argue that employee have little control over the shares of that particular company. There is even so much that management can do. There are some things that can affect share price. So why compensate them for things they don't even have full control over? Now, share-based compensation, it has been argued, can also lead to suboptimal risk taking. So meaning that, for instance, assuming there is a particular activity that it might impact the company negatively in the next 2 years, next 3 years in the short term, but in the long run is the best thing to do, and the company is going to benefit from it, right? Because the person has share-based compensation, and let's assume that it's going to vest in the next whole year. The manager can be saying that, look, oh, don't worry, I don't want to take that risk, oh, because I don't want the value of my shares to reduce, right? So then also the converse is that, right, it can also lead to excessive risk taking, particularly when we're talking about stock option. We'll talk more about stock option, and then probably I will come back to this point to explain more about it. Then it can lead to concentration in the employee's wealth, right? When you get to level 3, one of the topics that you'll be talking about is individual wealth portfolio. Because as a particular individual, you notice that even once you are working for a particular company, the company is paying for your salary and all, your wealth automatically is even concentrated in that particular company. Because if anything happens to that particular company, your salary will be affected, and even your financial position might be affected. Now imagine that they are now giving you share-based compensation, that your assets will also now include shares in that particular company. So that might be huge concentration in your wealth. So that one can also lead to a particular. So assuming that something happens to that company, you may actually have a significant decline in your asset portfolio. Now, the other disadvantage is that it has implicit costs, right? There are opportunities costs for it. For instance, you are leading to dilution of the share of the ownership stake of the shareholders. And even at times, to avoid that dilution, some company buy back some of their shares, right, to be able to adjust for the amount that they are issuing to ensure that they don't ultimately end up with plenty shares. That one also have implicit cost of that particular company. Okay, right. Now, so now let's talk a bit about, I think I've done now for RSUs. I'm sure you also I've talked about the share-based compensation. Then for share-based compensation, like I told you, the grant dates, that's the value of you get the value of the shares on the date in which it is being awarded to the employee. Then the vesting periods, of course, that I think like I mentioned, that's when you expense the value of the shares, which is the compensation expense. Now, there are different vesting conditions. Some will tell you you can have service condition, which says the number of period in which you have worked. Then you can have performance condition, which says that, look, the ROE or some metrics must be within a particular threshold for you to qualify for it. So you can say that, look, the ROE of the company must be higher than 2%. Your EPS must not be lower than this, all through the vesting period for you to qualify for it. Call that one performance condition. Now, there is also a subset of performance condition called market condition. That market condition is if you are using the share price of the company to determine the vesting condition, right? So, for instance, if you are looking about the share price of that particular company. Now, note that at the beginning of the period, remember that I said that you are going to expense the value of those shares over that period. But you know that in reality, right, particularly for a legacy large organization, not all employees wait. Some, they even tell them that the value of this thing is in 5 years. They tell you that, look, I'm going for somewhere else. So even some, for some reasons, will not wait. So that means that the amount that you need to adjust for the amount that you spend for what we call forfeitures. Forfeitures are those that you think that is the value of those that won't wait, those that won't ultimately vest, those that you won't actually even issue. So at the beginning of the period, what you typically do is that to make your assumption. So for instance, at the beginning of the 5-year period, assume how much they won't vest, and then you deduct it from the compensation expense that you expense over that particular period. Now, periodically at the end of each year, you need to adjust, you need to check your assumption about forfeitures. Have you overestimated it or underestimated it? That one you might need to also use it to adjust how much you are expensing all through that particular period. And of course, at the settlement date, the shares are issued to the employee. Okay. Now, for the stock option is a bit different. Now, for stock option is giving you a right, it's giving the employee the right to buy the shares of the company at the future date, but the price is determined today. Note that stock option is different from employee share ownership scheme. Employee share ownership scheme is the one that give the employee the right to buy the shares of the company, right? At the value on the settlement date, is not on the grant date. However, this thing is valuable, particularly for companies that are not listed. If it's a private company, right, that means that you can't even have access to those shares if it's not employee share purchase scheme. Okay. But for the stock option, is allowing you to buy the shares of the company at the price, at the price of today. Strike price is determined what is determined today. However, you pay the full value during that particular settlement period. Now, for stock option, you are given a period to acquire those assets. So the right word is that for stock option, we don't have settlement dates, we have settlement period. So you can be given a stock option saying that you are allowed to buy, let's say 1 million shares of the company, right? In the next 5 years, if you meet all the vesting condition. However, you have 3 years to buy those shares. So that means that after the vesting period, you have 3 years to actually even make those purchase, right? And if it's not if you don't take it after that one, it expires. And of course, you agree with me that you only take up that option if the value is lower than what's the price in the market. If the market is 50 naira, and even you are telling me that the strike price, the value that you're allowing me, you are saying that I should come and buy it at 55. I'd rather go to the market and actually even buy it. Okay. Now, note that for stock option, the cost to that particular company is the option that you are giving to that employee. Because remember that there's a risk that the price might actually even go up, right? So that is the cost to the company. Remember that the employee would pay fully for the shares at the settlement date. So that option would need to value it, and the company must bear that particular cost. One method that you must still use to value it. There are a lot of methods that you can use. However, the method I use must be consistent with the fair value measurement requirements, must be based on established principles of financial economy or financial economic theory, and thirdly, must reflect all substantive characteristics of the award. So you can use any of your traditional Black School option model, binomial option model. Don't worry, don't be scared. You don't need to learn those options in this particular under this particular topic. Now, but the only thing that you need to do is to make disclosures about the estimates that are used for valuing those options, the volatility, the risk-free rate, estimating 30-year life, all those ones, we need to have it in the you need to disclose that. And you agree with me that out of those factors that determine the stock value, right? The volatility assumption is the most subjective, while the exercise price is the what most objective, because that's the one that we already know today. Now, tax-based compensation have tax implication, right? Why do we say so? Remember that remember, of course, remember from your level 1 that your financial statements can be a bit different from your tax reports. Now, remember that in your financial statement, based on what we've discussed, we are going to use the value of those shares on the grant dates to determine the share-based compensation expense. However, the tax can only use the value of the shares on the settlement date. And there might be differences in the value of those of the value of the shares on the grant date and the value on the settlement date. Right? So so that means that one can lead to a tax windfall or a shortfall. So for instance, assuming that the share price on the settlement date is higher, that means that the share-based compensation expense in your tax reports will be higher than what you have in your financial reports. Ultimately, that means that the expenses will be higher in your tax reports, then the taxes that you are required to pay will be lower compared to what you have in your income statement. Given that is your tax report that determine ultimately what you have to pay, that means that we give you a windfall or a excess tax benefit, because you won't pay as much as what you've estimated in your income statement. If the other thing actually even holds, assuming that it's the other way around, that the share price on the settlement date is lower than what you have on the grant date, that means that what you have in your financial statement is going to be higher right? That expense is going to be higher than what you have in your tax report. And in that case, it means that, look, you have a tax shortfall because you need to pay more than what you have in your income statement, what you provided for your income statement. Of course, know now that the so-called the tax expense, your income statement is more like a provision. It's your tax report that will determine ultimately how much tax that you pay. Now, how your tax windfall or shortfall is treated is slightly different under IFRS relative to what we have under US GAAP. Under IFRS, the adjustment of your tax windfall or tax shortfall, it is done in your equities, right? It's not done on the income statement. However, for US GAAP, that windfall or shortfall, the adjustment is done on the income statements in the tax expense. Okay, you make that adjustment in the tax expense. So that means that your effective tax rate under US GAAP can actually be volatile based on this adjustment that you've made if you have share-based compensation. Okay, right? And it will also make the effective tax rate to be different from the statutory tax rates under what? Under US GAAP. Now, remember that under level 1, you learned about EPS and diluted EPS, right? Share-based compensation can also lead to increase in your diluted EPS. And remember that when you are computing your EPS, you are using the outstanding shares. And when you are using your normal EPS, you use your basic outstanding shares, right? And when you are using your diluted EPS, use your diluted outstanding shares. For you are seeing a company that one of the implications of share-based compensation is that, look, you can have a significant increase in your outstanding shares, even when you've not done a rights issue or no IPO. Because as you're using shares to your employees, the number of shares can actually increase if you are not buying it back from the markets. So your outstanding shares can be increasing, which will affect your EPS, right? When you have share-based compensation. Now, for diluted EPS, you know that at times you might have some shares that have not vested, right? And those your shares that have not vested can actually be dilutive. And if they are dilutive, you need to add it to your computation of your what? Of your diluted outstanding shares, which will be used to compute your diluted EPS. So to get your diluted outstanding shares is your basic outstanding shares, which is number of shares that you have already issued, then the share from conversion of stock award. So you add the potential shares that will be issued whenever those share-based compensation, whenever they vest, and then you subtract assumed repurchases. Remember that, like I mentioned earlier, a company might have a policy of buying back some of the shares in the market. If you have that particular policy, right, then you need to assume the volume that you think will be repurchased, right? And of course, the amount that you think will be repurchased will be your what? Assume proceed from conversion divided by the average number of shares. Okay. Now, so let's talk a bit about post-employment benefits, right? And then some of them can be cash or non-cash. The non-cash is simply most often times your pension, while the non-cash benefits are your insurance, life assurance, and then some other benefits that the retirees typically get. In terms of pension, like you all know, you can have defined benefit um, to have defined benefit or defined contribution. Zainab, which slide do you want us to talk about? And can you be a bit more specific on the one you want us to talk about and the one? Okay, are you talking about this one? Zainab, try and be specific so that I will know the one to go back to. Okay, right. Okay, so okay, cool. Now, so remember that you compute your EPS. You can have your EPS or you can have your diluted EPS, your basic EPS and your diluted EPS. For your basic EPS, what you use is your basic outstanding shares. While you diluted EPS, use your what? Your diluted outstanding shares. For your basic outstanding shares, like I mentioned, what can cause it, right, to increase? It might not use you an IPO, but number of shares can actually increase. For your diluted outstanding shares, remember your diluted outstanding shares, we use the treasury stock option that you learn in level 1. And what does the treasury stock option do? what we do, we are saying that all the potential securities that you think might turn to outstanding shares, we are going to add it together. Then, if there's one that you think that is going to reduce the number of outstanding shares in the future, what do you do is reduce it, right? To get your diluted outstanding shares. And for us to get your diluted outstanding shares, what you do is that the number of shares that you've issued now, you add the potential securities that can actually that you think that will lead to an increase in your outstanding shares in the future. And one of those instruments is your what? Is your stock-based compensation, is your stock awards, right? Then remember, like I mentioned, that oftentimes some companies buy back some of their shares in the markets. So to get the net effect in the future, as we are adding the number of free shares that will be issued, we need to also deduct the number of shares that we think the company will repurchase from that particular market. So that means your diluted outstanding shares is your basic outstanding shares plus shares from the conversion of stock awards minus assumed repurchase shares. Okay, so your assumed repurchase shares is the assumed proceeds from the share structure from the conversion of the shares divided by the average share price in the period. So meaning that assuming that it's going to be assuming the what do you call it is going to be an employee that was going to assuming that it's stock option. Remember that the employee will pay for it. So that will be your cash proceed. Now let me also add this for RSUs or stock awards. What we use as the assumed proceed here is the average of the compensation that we are going to expense. So what do I mean? Assuming that we have like a share-based compensation that we're going to vest over 3 years. Remember that the total amount of that compensation, we will spread it over 3 years. Now that means that assuming that we are in year 2 now, what will be the assumed proceed from share-based compensation will be the opening balance of the amount that we want to expense plus the closing balance divided by 2, the average, opening plus closing divided by 2 of the amount that we are going to expense in the future. So that means the one that will be for year 2, year 3, that one that yet to be expensed, that will be the assumed proceeds from the what? Share-based compensation. Okay, I think I've even explained unrecognized share-based compensation. I think I've mentioned that. So, like I mentioned, the assumed proceeds would be either cash proceeds from the exercise if you have a stock option in which the employee will pay for it, or the average unrecognized share-based compensation expense, meaning that the one that you are yet to recognize. Okay, Zainab, I hope you are fine now. Now, talking about share-based, talking about employee benefit, like I mentioned. Let's go to pensions. There are 2 of them: defined contribution and defined benefits. For defined contribution is the one in which the employer and at times the employee they make a contribution into a particular pool of assets that is managed by an external agent. Oftentimes, it's the employee that chooses it, right? You are the one that will determine it because the employee is the one that will be responsible on how that particular portfolio is managed. So meaning that the employee bears both the investment risk and the actuarial risk. Okay, right? That employee bears it, right? And then the liability of the employer is only based on the amount that is being contributed. You don't have any obligation except those that you've actually even paid for it. So reporting for defined contribution plan is very simple. For the employer, the only thing that you take into your income statement is the amount that the amount that's due that vests over that particular period, and it's short-based compensation. Then the balance sheet also, right? The balance sheet is contribution made to reduce, of course, the amount that you've contributed. Once you make that payment to reduce the cash balance, then the cash flow, right? It's the amount that you've actually even expensed that actually goes into your cash flow statements. For a defined benefits plan, like you all know, that is the one that you pay from retirement until the person dies. It can be in lump sum or it can be periodically, right? And for you to get that, for you to qualify for the defined benefits plan, you must have, that's a vesting period. Oftentimes, you must have worked for a particular number of years, right? So, and then now you must actually even work for a number of years. And the amount that you're entitled to, there's a formula to actually even determine it. Oftentimes, it can be a percentage of your final salary, number of years that you've worked, and then the the final year salary. Now, employers, they are required, although it's their obligation to make that payment in future, to ensure that the company can easily meet this obligation. The company is required to set aside assets that will be used to meet those obligations in the future. And to ensure that even if the company goes down, the retirees still get their funds. Oftentimes, they are meant to give it to a trustee or a bankruptcy remote entity, so that if the company goes down, nothing happens to that particular funds. Okay, there are some companies, there are some entities, some jurisdiction that have the minimum amount that was set aside, and some don't have minimum amount that was set aside. But please note that the amount that you are setting aside is often tax deductible, and some companies use it for their own tax planning. Here, one of the major difference between defined contribution and defined pension is that, look, the employer bears the actuarial risk and investment risk under the defined benefit plan. Some people ask, what's the actuarial risk? It's simply think about that longevity risk, the risk that the person will outlive how much asset has been set aside, right? That's the actuarial risk. While the investment risk is risk that, look, the assets will not generate enough return to meet those obligations. Okay? Now, often for most, because of the issues that are associated with defined benefit, but most countries have moved to a defined contribution plan, except for Japan and Netherlands, right? However, there's something that I need to also remember is what we call difference between closed plans and frozen plan. A closed plan is the one that we are not admitting new employees, we are closing it. However, for those that are already inside, the value of those investments is still growing up. The value of how much they're entitled to is still increasing. But for a frozen plan, not only have we stopped admitting new people, the value of your benefit is already frozen. It doesn't increase from that day. Okay, from the day that it's frozen. So please note the differences between the two of them. It's subtle, but don't forget it. Now, okay, actuarial risk is the risk that the person will outlive the investment. So, for instance, let's assume that the person retires at age 65, and the assumption in determining the assets, and even you can say that let's assume that on the average, people live up to 80 in that particular environment. So you can be assuming that, oh, let me plan, at least the person can live more than 80, or you can even say worst case 83. But assuming that you are saying that all those your former employees, they are living up to like 85, 90, 92, can you see that they would have actually even the amount that you pay to them is going to be more than what you've estimated. So that is actuarial risk, the risk that you're going to live longer than the assets. So for the defined contribution plan, right, the risk that which we are seeing now in Nigeria is that, look, the amount that they've contributed over the years, right, they are outliving how much the money that they've actually contributed, right? So they're living longer than was estimated in determining how much they should pay. I hope that one is clear. Right. So how do we account for defined benefits plan? For defined benefits plan, right, I think the accounting for it is a bit different from defined contribution. What we do here is for the benefit, remember that the benefits will be paid in the future. Those are the liabilities. But since they will be paid in the future, you agree with me that it's not right for us to be recognizing the total obligation in the future. What we do is to recognize the discounted amount, right? We need to first estimate how much will be in the future. Remember that one also is something that is difficult to do, but we need to have different, what we call actuarial assumptions. Assumption about how long they will live, the retirement date. Because if you're estimating it today, you're assuming how long the person will live after retirement. You're even assuming how many of your employees will stay until retirement. How many of them, what will be their final salary? All those things, we call it actuarial assumption. You need to use it in determining the fair value of those obligation in future, and then the present value of those obligation, right? Then also remember that you also need to now to get that fair value, what we use as a discount rate is the yield on investment grade corporate bond with the same with the same currency and the same duration as the pension portfolio. However, if you don't have very liquid corporate bond market like in Nigeria, right? The corporate bond market is not that liquid. You can use the yield of the appropriate treasury securities. Okay. Now, so what do we have on the balance sheet? What we record on the balance sheet is the funding status, right? Which is the difference between the plant asset. Remember that I said that the plant asset, the asset that you set aside, and the present value of the pension obligation. So that difference between the two of them, which is called the funding status, is what we have on the balance sheet. Okay, right. And on the balance sheet, you can have a net pension asset or net pension liability. For net pension asset, you have a net pension asset if the asset is more than the liabilities, if the pension asset is more than the liabilities, right? If the fair value of the plan asset is more than the present value of the pension obligation. However, you have the net pension liability if the PV of the pension obligation is higher than the fair value of the pension asset. So oftentimes it's rare for you to have both of them. You only have both of them, right? If you have more than one pension fund. Remember, like I mentioned, you might have your defined benefits plan. You can have other post-employment plan also, right? Maybe the one for else and all can get the value and all. That is when you have both asset and liability. But typically, if you have just one, you have either asset liability. Now, let's talk about the income statement. The way we record, now the first question is, what do we record in the income statement in terms of pension? What we record in the income statement is the movement between the net funding status. Don't forget, the standing status is the difference between your present value of pension obligation and the fair value of the pension assets. So that net funding status, the movement during the year, it's what goes into the income statement. Now, the classification of that movement under IFRS is a bit different under what US GAAP. Under IFRS, right, that movement, right, there are three things that actually even contribute to that movement. The first one is the service cost. The second one is the net interest income or expense. And the third one is remeasurements. For your service costs, we have what we call your current service cost and the past service cost. Past service cost, current service costs are the increase in your pension liability, in the pension liability, or what you've earned as an employee by working for another year. While for past service costs, these are changes, right? Retroactive changes in the pension formula, right? In even determining how much you qualify for. So those are the percentages you have under service costs. The net interest income, right, is simply the assumed interest rates, which, like I told you earlier, is the rate on the liquid corporate bond with the same duration and currency as the pension liability, or the equivalent treasury securities if you don't have a pension, if you don't have a liquid corporate bond market, multiplied by the opening funding status. That's what will give you your net interest income or net interest expense. Now, the third one is remeasurements. Remeasurements is what you have in the remeasurements, actuarial gains. So, for instance, when there are changes in your actuarial assumptions, right, that means that the pension obligation will actually even change. And that one can result into gains or losses by the time you get the fair value of those instruments. So you can have actuarial gain or actuarial losses. Okay. And then also we can have actual return on pension assets, and then the difference between the actual return on pension assets and then the return on the plan asset based on the discount rates. So the difference between the two of them. Okay, that one also enter our remeasurement. Please note, the measurements goes into your OCI and is there permanently, while service cost and net interest income or expense goes into your income statement. Now, under US GAAP is almost the same thing, but they classify it into 5 and not 3. So the first thing that you have there is your current service source, which is how much that you've earned, how much increase in your pension that you've earned, yeah, because by working for another year. Interest cost or interest expense, right, is the movement in the pension obligation during that particular year, right? Because remember that we've discounted it. If we've discounted it, the value will also be increasing as you are moving towards towards the future, right? And that difference in value because of movement of time. That's what we have in the interest cost. Then expected return on planned assets, which is how much expected return that we, based on the past experience, that we think the assets will generate. Then amortization of the past service costs. Remember that past service costs, the changes in the planned, the changes in the assumption or what you earn, right? Retroactive changes in the computation of your pension, right? What we do, remember that under IFRS, what we do is just expense it. Under US GAAP, what we do is to amortize it over the remaining life of the employee. Next is also amortization of net gain of losses. Now, actual gain and losses, remember that under IFRS, what do? It stays in remeasurement in your OCI, right? Permanently. But here, under US GAAP, you have two choices. You can either take them to the income statement and expense them once, or you can gradually expense them in the income statement using what we call the corridor approach. And what's the corridor approach? It's simply saying that you will compare the value of actual gain or losses, right? You compare it with 10% of the higher of the opening assets or opening liability. So what do I mean? The fair value of the opening assets, you get it. You get 10% of it. Get 10% of the present value of the pension obligation. Get it. The higher of the two, right? Then you now compare it with the cumulative actual gain or losses. If the actual gain or losses is higher, that difference that is higher, you can now what? Amortize it in the income statement just to smoothen it to ensure that the impact is not much on the income on the income statements. Okay. The cash flow statement, what enter the cash flow statement, simply your contribution to defined benefits, either defined benefits plan or defined compensation, defined contribution plan. Okay. Okay, good. Now, Jimika, now actual gain or losses are simply changes in valuation of the portfolio because you are adjusting some assumptions. So, for instance, assuming that people used to live for like, let's say 62, but you notice that they're living longer to like 67, you agree with them that it will affect the value of those portfolio. Because remember that you're going to pay them until they die. That means you have more obligation. And of course, it will affect the value of that particular obligation, both the future value and the present value. That is actual gains, right? Those are actual gains or losses. Okay. Of course, that adjustment can be positive or negative. Now, for past service costs, what do I mean? Let's assume that the formula is saying 1% of your salary, 1% of your salary on the year you are retiring, multiplied by the number of years that you worked. Assuming that we are saying that, oh, let's adjust this to 1.5%. That 0.5%, remember that you agree, and let's say now, Azuna saying that we're not saying that it's going forward, we are saying that we're going to now effect that change for the past 3 years. So that change that we impact for the past 3 years is what we call past service costs. So it's those changes in computation, but we are now applying it retrospectively. That's past service costs. I use that is different from actual gain or losses. Okay. Now, when we say now, okay, Ari, do you mean that amortize is added to? Of course, yes. What I mean that amortize, and when I said that is yes, what I mean is that it is expense in the income statement. That means it's, of course, it goes as part of your expenses that you see in the income statement. That's what we mean. But don't forget that for past service costs, right? Yes, like I mentioned, yeah, under IFRS, it's expense ones, but for under US GAAP, what we do is that we amortize it over the remaining work life of the employee. Okay, I hope that's fine, Jimika. Okay, right. Let's quickly take a deep dive into analyzing financial institutions, right? And then yeah, like you all know that under this topic, we want to look at how to analyze banks and insurance, right? Insurance companies. So let's also look at the differences between financial institution and other corporates that we have in the market. One, financial institutions, they deal with financial assets such as loans, investment securities, right? Which are not changeable. However, when you see corporate merchandising companies, they deal with what? Physical tangible goods, right? And then because of the nature of the asset that they are exposed to, you see that the major risk that financial institutions contend with are credit risk, liquidity risk, and market risk, right? And then also you see that for although some other corporates might have this, but it's not as significant as we have in financial institutions. Then financial institutions, particularly banks, right? They are essential. What they do is financial intermediation, and they are essential for a properly manned economy. And you see that they are also ingrained into most economies, such that they create what we call systemic risk and contagion risk. Systemic risk, right, is simple. So the question is, what is systemic risk? It's simply a risk that the whole financial system will actually be impaired, will actually be in trouble because of trouble in a particular section or one or two institutions. Remember the financial crisis, right? Caused by the global financial, was just caused by just some securities in some remote countries of US, right? These are the things that cause systemic risk. Similar that the whole system is vulnerable to the performance of what? The financial institutions. Then similar to that is what we call contagion risk, is that because the financial institutions are linked together, if care is not taken, if there's issues with a particular financial institution, it can spread to others easily. Remember what happened to SBV Bank, right? Silicon Valley Bank, how it affected Swiss Re. And if not that some serious issues were taken, it would have actually even spread all over the world. Okay. Now, how do we analyze banks? Right? We use the traditional CAMELS approach, and we stand for capital adequacy, asset quality, management capabilities, earning sufficiency, liquidity position, and sensitivity to market risk. So for capital adequacy, right, that one look at capital. Remember that capital for a bank is very important because use it to absorb losses, right? Although you are doing intermediation, remember you're taking money from the surplus to give to the deficit, with the ultimate belief that you collect it back from the deficit and return it back to the surplus. If you can't collect it back from the deficit side, the surplus guy does not want to, he wants his money back. That loss, how do you pay with it? Is your capital. So capital must be strong. So in terms of capital, capital can broadly be divided into tier 1 capital and tier 2 capital. Tier 1 capital is those that are permanent in nature. Okay? While tier 2 capital are those that have relatively long term, oftentimes with maturity of more than 5 years, right? Then for tier 1 capital, your tier 1 capital can broadly be divided into two, what we call the common equity tier 1 capital and additional tier 1 capital. So your common equity tier 1 capital, if you remember, is simply your shareholders' funds, right? While your additional tier 1 capital are instruments that don't have maturity, right? They are not your they're not part of your shareholders' funds, right? They're not your traditional shareholders' funds, right? However, they don't have maturity dates. They don't have they are not part of you, they don't have maturity dates. And then even the return that you're paying is now dependent on the bank, not on that particular, not on the investor. And that is where how your ATM, the additional tier 1 capital, typically also come on your AT1 that a lot of banks in Nigeria issued a couple of years ago. Then your tier 2 capital, right? Like I mentioned, it must be long term with a minimum of 5 years, and then it must be subordinated to all other debt, obligation, or liabilities of that particular bank. Okay. Now, the standard says that your common equity tier 1 capital must not be lower than 4.5% of your risk-weighted assets, right? For your total tier 1 capital must not be less than 6% of your risk-weighted assets, while for your total capital, both tier 1 and tier 2 should not be lower than 8%. Now, in banking, we use what we call risk-weighted asset, not total asset. And what's your risk-weighted asset? Is simply each asset adjusted for the risk that we have inherent in it. So you agree with me that the risk that you have on loans is way higher than the risk that you have on cash. And even within the loan buckets, you agree with me that the loan to a large corporate might actually be different from loan to individuals. So that's your risk-weighted assets. Okay. Then you have your asset quality, which look at the quality of the assets that you have in your books. And also, don't also forget that under asset quality, Don't forget that you need to also look at your what. You need to also remember that there's no way you can assess the quality of a company, a bank's assets, without looking at the quality of the risk management, because the risk management is like the gatekeeping, is the gatekeepers, right? The risk management division there. Okay. Then of course we look at the management capability. How the management, and if you look at the management, how do you assess the capability of management? There's no way we assess capability of management without looking at the role of management. And if you're looking at the role of management, there are two things that you need to focus on. What's the role of management? There are two things that they do. One, they either help you to what do you call it? They either help you to um they either help you to identify and assess opportunities, and number two, they help you to manage risk. So these are the two metrics in which we use to assess management. And of course, from that, we'll be looking at performance of the company, compliance with the various regulations, right? The quality of the board director, all those ones has to do with management capability. Then in terms of earning sufficiency, right? In terms of earning sufficiency, what we are looking at is that what is the size of the earnings? What's the quality of the earnings? And is it sustainable? And if you remember from level one, right, the quality of the earnings there, we're talking about quality of earnings, we're talking about the cash elements that you have in your income statements, right? In your profit after tax. Which one of the elements is cash? Which one is non-cash elements? Because remember that you learned that the cash element is the one that is quite sustainable, okay, compared to the non-cash elements. Then also, the next question is that earnings, is it sufficient? Is this something that is sustainable? Is this earnings, even if the quality is great, is it actually one-off, right? We look at that also. Then liquidity position is very important for a bank to be very, very liquid. And like I say, for a bank, it's not only for you to be liquid. You must not only be liquid, you must be seen to be liquid. So it's very, very important. And of course, this is where your liquidity coverage ratio and your net stable funding ratio comes in. Remember that your liquidity funding ratio is looking at your liquid assets as a percentage of all your requirements, your liquidity requirements in your most stressed period. So meaning that looking at your history, or even look at, based on even your history or your future, how much within a 30 days period, how long do you think you actually even be stressed? Okay. Then we look at that particular 30-day period. And what we do there, you look at that one, look at the amount that you think you'll be stressed with, and then you compare it to the liquid asset that you have. And your liquidity coverage ratio says that it must be more of 100%. Okay. And that one is focused on your short-term need. For your net stable funding ratio, we are looking at the long term. And what do we do here? You are maturity adjusting your assets and maturity adjusting your liability to see if you've actually matched them together. Okay, right. And then your net stable funding ratio must be 100%. Then, of course, you have your sensitivity to market risk. Now, the Camel's approach is very, very comprehensive. However, it's very good. But we notice that there are some things that are actually missing there. So in addition to looking at the Camel's approach, there are some other things that determine that we look at when you're analyzing banks. You look at the level of government support, government ownership, mission of the bank, the culture of the bank, off-balance sheet items, segment information, currency exposure, risk factors, and also the level of disclosures. Okay, right. All those things, we also look at it when you are analyzing a bank. Now, lastly, let's talk about insurance companies. Like we all know, insurance companies are simply companies that promise to indemnify us whenever a particular risk crystallizes in exchange for premium. So you pay premium now, and then the company will indemnify you if a particular risk crystallizes. Okay? Right. And then what you also see is that, look, for the insurance company, that risk, they can't carry everything. They might not carry everything in their books. They also have venue for them to also transfer it to other insurance company, which is very important. It's a very important element in risk management for insurance companies. So to transfer it, you can either use co-insurance, which is when you're sharing the risk with other insurance company, or reinsurance when you're transferring it to reinsurance companies. So the reinsurance company is the insurance company of the insurance companies, right? It's just a way of actually even sharing it. Okay. And insurance company, what they try to do is to ensure that there's low correlation in the portfolio. just to ensure that the losses in the portfolio is minimized. Now, we can classify insurance company broadly into two: non-life insurance company and life insurance company. Life insurance company are simply companies that underwrite risks that has to do with life, health, and any related activities. While non-life insurance company are insurance company that focus on products that exclude life and medical related fields. Right? Another name for non-life insurance company is general. Some people call it general insurance company. So they mean the same thing. Now, when you're analyzing insurance companies, there are 5 elements that you focus on: the business profile, the earnings, the investment management, liquidity management, and also what? The capitalization level of the insurance company. Now, in terms of business profile, what you see for non-life company is that the non-life insurance contract are simply annual. So that means you have it for a year and they are renewable annually, and premium is paid once in a year. Right? And then what you also notice, or something that you notice is that, look, for non-life company, of course, for non-life company, their claims are highly volatile compared to life companies. For life companies, there's something that they call mortality table, which is simply a table prepared by actuaries that shows the number of how long somebody is meant to live in a particular area based on his lifestyle and all the things that this where he lives, his lifestyle and all. So that mortality table help insurance company to predict how long somebody will live based on those information. So because of that, you see that the death claims that life insurance company pays are typically predictable. But for a non-life insurance company, it is highly unpredictable. For instance, I can insure a car today, and before you wake up tomorrow morning, the car is involved in an accident. You don't have a choice. You have to compensate that particular company, that particular person. Now, in terms of earnings, right, what you see is that the major cost of insurance companies are claims, which is the amount that you pay, compensation that you pay to the insured whenever the risk crystallizes. Now, then there are some ratios that are very important looking at the earnings of insurance company. They are very important. Okay. They are peculiar to insurance company. The first one is what we call the average loss ratio. So your average loss ratio is the claims plus changes in reserves divided by your net premium. Remember that your premium is what you get from the insured. Then when you subtract your reinsurance expenses from it, what do you get? You get your net premium. Now, the way you have provisions for banks, as an insurance company, you also need to provide for claims that they've not yet made. So what do I mean? On the 31st of December, when you are preparing your account, there are some accidents that might be happening that day. There might be some losses that you are recording the day. There are some that day that you don't know yet. There is some that the person has not even, they have not reported. There are some that they've reported that you are still working on. So you need to make provision for that one. We call it reserving in insurance. So the the claims that you have this year, plus the reserves that you've made, right, as a percentage of your net premium is what we call the average loss ratio. Note that this is an expense ratio. So the lower the better, the higher the worse for that particular ratio. Now, there's another one that we call underwriting expense ratio. Your underwriting expense ratio focuses on all the expenses that the insurance company incurred in getting that business. Now, for insurance company, you will see that most insurance markets are broker driven, meaning that you have a lot is insurance brokers that help them to get a lot of insurance business. So you need to pay commission to those brokers. Okay, of course. Apart from that, also you print materials, all the costs associated in getting that business is what we call underwriting expense. So your underwriting expense as a percentage of your net premium is your what? Is your underwriting expense ratio. It's a very important ratio for you to look at. Don't forget also, it's an expense ratio, and because of that, the lower the better. Then the other very important one is what we call the combined ratio. The combined ratio here, we are adding your underwriting expenses with your loss and the additional reserve you made during the year as a percentage of your net premium, right? Simply put, your combined ratio is all the costs from the insurance activities as a percentage of your net premium. Okay. Then, of course, that's very important. Then for your investment management, what do you have under investment management? Now, what I will say under investment management is that you need to note that, look, for insurance, for non-life insurance company, because their claims are highly volatile, they invest a lot in liquid assets, right? Things like placements, some of them don't even do equities, right? However, for non-life companies, focus on they can do long, like focus on long-term instruments. In terms of liquidity, insurance companies needs to be liquid, right, to be able to meet those obligations. However, a non-life companies needs to be more liquid than a life company. In terms of capital, unlike the banks, when you have Basel or universal regulation, we don't have a universal regulation for insurance company. But however, note that given the volatility of non-life companies, the capital requirement is higher compared to that of what? A life company. Okay, I think that would be all for the class. Like I know that you might have some question. What I will do, let me drop my number. Okay, so okay. Gloria, can I take any question or my time is up? Can I take one or two questions?
Okay, I think you can take just one in the
Okay.
interest of the next facilitator. Yes.
Okay. Yeah. So is there any question? Is there any question? Any question on what we've done so far? Okay. Okay. Yeah. If there are no questions, please, all the best in your exam. In case you have questions when you are reading or something, this is my phone number. You can reach out to me. It's also my WhatsApp number. So we can actually even take this offline and also even answer any question that you have. Okay. Thank you very much. All the best in your exam.
All right. Thank you so much, Ayo. Thank you very much. And the next class for today is a member of CFA Society Nigeria. Jamdari, you can go ahead and share your screen and start your session.
Thank you very much, Gloria, and good morning, everyone. I hope we are doing great and fully prepared, I'd say, for the level 2 exams. So I'm sharing my screen now. Okay, I believe you can see my screen. So I will just say again, welcome to this boot camp, and of course, congratulations to have made it to level 2, and I wish you success as well in this level 2. And one thing we are trying to do at this point is to try and compress the curriculum as much as possible within the time that we have. And for this particular session, we'll be looking at level 2 equity valuation. So the way it's going to run, for the most part, I'm just going to do a brief overview of some of the concepts that I think are very important for us to note, and then would have some time, in fact, a lot of time to solve some questions, because I believe that one of the things that can help you to scale through this level 2 is to solve as many questions as possible. So I encourage you that even beyond this boot camp, if you've not been solving questions before, please solve as many questions as possible. And that's the approach we are going to take as well. So equity valuation, definitely we won't be able to cover everything within 1 hour, 30 minutes, but we'll just look at some of the key things and back them up with questions, as I've said. And looking at the first topic, equity valuation applications and processes, there are a couple of learning outcomes that the curriculum wants us to be able to have covered by the time you've read the topic. But of course, I'm not going to bore you with the learning outcomes. You can go back to that. I'm going to just start with the key concepts. The first one is valuation. Just looking at it, the this particular subject is called equity valuation. So we need to understand what valuation is and how that differs from when we say market price. Valuation is just an estimate of an asset's value based on different variables that might relate to either fundamentals, or even sometimes the analyst's discretion comes into play when you are doing valuation. But mostly you want to talk about valuation in terms of how you view the future prospects of that particular asset. It can be an asset that you are trying to, mostly an asset that you are trying to value. But for the purpose of this particular reading, we are talking of equities. But definitely, you can value different things. You can value an apartment. You can value a building. You can value a jewelry. You can value anything. But here we are talking about equities. So the estimates of an equities being an asset class based on different variables relating to the future investment returns or comparisons with similar assets. Those are the things that you do when you're talking about valuation. And when we do valuation, we get something that we call an intrinsic value. And we said that is different from market price. Now, intrinsic value of an asset is the value of the asset based on the understanding that an analyst or the valuer has about that asset's characteristics. So you are looking at an equities, you are looking at a particular stock. Say, for instance, the Nigerian stock market, you pick a particular stock, let's say GTCO, Guarantee Trusts Company, and then you are looking at where is the company today, where has it been coming from in the past, but most importantly, where do we think it is going in the future as a company, as a going concern, as a business entity? Where is that company going or headed in the future? And then we use all of those characteristics to say, okay, based on our belief as the analyst, based on our evaluation of the characteristics of this particular stock, this is what we think the value of a stock of GTCO is. So that value that we've assigned to it, maybe we say the value is 150 naira per share. That is what we call intrinsic value. And the second point there says it's an estimate of intrinsic value. An estimate of intrinsic value reflects one's view or the true or real value of an asset. So that is why I said that when you are doing intrinsic value, yes, you look at fundamentals, you look at the historical, you look at the present, and most importantly, you look at the future, your belief about where the company is headed. But in addition to all of those things, it also reflects your belief. Sometimes the analyst discretion comes in when you are doing evaluation, and you can't take away the impact or the value that the analyst discretion also as to impact the intrinsic value. And we emphasize again that intrinsic value is different from market price. Market price is the current price of the particular stock. I'm not going to say too much on that because I believe all of us know that already, that market price is a current price, while intrinsic value is an estimate of what you think the asset is worth or is going to be worth in the future. And then when you compare intrinsic value and market price, sometimes they are different. When they are different, you say there is a mispricing, which takes us to the third important concept. Any departure of market price from the analyst's estimate of intrinsic value is called a mispricing. It could be that the intrinsic value is higher than the market price. It could be that the intrinsic value is lower than the market price. Whether it is higher or it is lower, you have what you call a mispricing. Now, if the intrinsic value, that is the estimate of the analyst, if it is higher than the market price, which means the current market price is lower than what the analyst believe the stock should be trading at, you say that that stock is currently undervalued. Is currently undervalued. Say, for instance, the stock of GT is currently trading, I'm just picking random numbers, is currently trading at 100 naira per share. But you, as an analyst, you've estimated that that stock is actually worth 150 naira. So it means that there is an opportunity to benefit, to gain from buying that shares at 100 naira today. So you say that stock is currently undervalued. Is currently undervalued. And just a disclaimer, me mentioning GTCO doesn't mean anything. I'm just using an example for us to relate to it. So nothing about this is investment advice, okay? So that's a mispricing. And in that instance, where the market price is lower than the intrinsic value, you say that there is the stock is undervalued. And if the reverse is the case, where the market price is higher than the intrinsic value, you say that the stock is overvalued. Say, for instance, the GTCO stock is still currently trading at 100 naira per share, but as an analyst, you've estimated the intrinsic value to just be 70 naira. So you then be wondering, why are investors pricing it at 100 naira? So based on your own belief and your estimate of the intrinsic value of 70 naira, the stock is overvalued at 100 naira market price. Okay. Um, so a going concern value is simply saying when we are estimating the value of a company and we assume that the company will continue to exist into the foreseeable future, which means there is no risk to the company folding up or liquidating. You value the assets or the company or whatever you are valuing based on a going concern basis. So when you say going concern value, it's simply the value of a company when you assume that the company will continue to exist into the future, foreseeable future. And the second bullet point is very important for us to note that we don't use a going concern value when a company is in financial distress. If any company that you are trying to value is in financial distress, then a going concern basis is not appropriate, because what it means is a company being in financial distress means the company can fold up at any point in time. So you can't assume that a company will continue to exist in perpetuity. And then lastly, when a company is in financial distress and it's about to be dissolved, then what you use is a liquidation value, a liquidation value. So going concern, you use that for a company that will continue to exist into the future in perpetuity, at least as an assumption, while you use liquidation value for a company that is going to be dissolved and its assets are going to be sold individually. Now, the next thing that the curriculum wants us to know is the valuation process. And of course, I'm not going to go into detail of each of them, but I'm just going to point out a few things that should form the basis of how we think about valuation process. Because based on experience as well, this is one area where questions can also come out. Yes, curriculum, we know that questions can come from anywhere, so everything in the curriculum is very important. But there are just a few things that we would try to emphasize based on, of course, belief as well, just thought process to say, okay, yes, this is likely more testable than this. But again, the curriculum says everything is testable, and we have to think like that as well. Now, there are five major steps when we want to that the curriculum has outlined in the evaluation process. One is that you have to first understand the business thoroughly. You can't value any stock without first understanding the fundamentals, the business. How does the business operate? How does it work? And some of the things that you use in understanding the business include your industry and competitive analysis, where you talk of different industry frameworks, such as the Potter's five forces. You have the Pestel analysis. You have the SWOT analysis that you also use to understand where does the company's or the business strengths lie, where are the opportunities, what are the weaknesses of that business, and what are the threats to the what are the existential threats to the business or the opportunity that you are evaluating. So you have to thoroughly understand that business using some of these important industry and competitive frameworks. Then you have the financial statement analysis, where what you do here is to analyze the historical performance or financial statement of the company. And I think the first session that we've had today covered financial. Was it financial analysis that you covered there? Whatever the case is, so it's important to do a financial statement analysis and to understand the business of the company from a financial point of view. Then you look at the strategy of that particular company. Is it a cost leader? Is it a differentiator in terms of the product? What is the focus, right? So you have cost leadership, you have differentiation, you have focus. When you say cost leadership, some companies are big in the markets and they are able to reduce their own price or to cut their cost of production because they are enjoying what we call economies of scale. So when a company is enjoying economies of scale and it appears to be the company that is operating at the lowest operational cost in the industry, say that company is a cost leader. So need to understand what the strategy of that company is. Is it strategy based on product differentiation, or is it that it is focusing on a particular segment, on a niche, market niche within the market? So that is very important to also analyze that company so that depending on the strategy that a company has adopted for its operations, you can know what the kind of risks are. If a company is a cost leader, can the company continue? You want to start raising questions like, can the company continue to reduce costs forever? Or are there points where it is no longer possible to reduce cost? You want to understand that. If the company has adopted a strategy where it's has a focus, in terms of maybe demography, let's say it's a company that focuses on the youth population, right? So you can say, okay, what is the demography like? Is the youth population in this particular market likely to continue to increase, or is it likely to continue to or likely to shrink in the nearest future? That can then help you understand what the future of the company that you are evaluating looks like based on the market niche that it is operating in. So it's just a very important thing to understand that corporate strategy is key to understanding the business of the company and in the valuation process. Then you also have what you call the sensitivity analysis, where you are changing parameters within your model to assess the influence of that on the valuation. So that is sensitivity analysis, changing model parameters. So you have different parameters when you do your model. You have your growth rate, you have your ratios, you have different parameters that you've used in your model. And then when you change them, and then you see the influence of changing those parameters on your valuation, that's sensitivity analysis. Second in the process is forecasting the company performance. Yes, you've done your financial statement analysis historical, then you then need to look at from that historical, how can we forecast performance? We know the historical, we know the strategy of the company. Is it maybe it is a cost leader, maybe it's a differentiator, or maybe it's focusing on a particular segment of the market. Based on all of these things that we understand about the business, we can then forecast the company's earnings into the future. And an important concept here is quality of earnings, where you evaluate both the sustainability and the accuracy of the numbers that you have. So both the sustainability, remember I said, for instance, a company that has a cost leadership strategy, is it sustainable to continue to reduce cost or to continue to operate at a low cost into the future? Or a company that focuses on the children, maybe the very young population, kids. What is the birth rate in that particular market? Is it increasing? Is it declining? So that helps you to understand the sustainability of the performance of the company, and the accuracy is also very important. So you do different things when you're doing quality of earnings to help you understand the sustainability and the accuracy of the reported numbers. The third thing is then to select the appropriate valuation model. And I think this is one of the areas where questions typically come out. because different methods are informed. The method you adopt in doing your valuation is informed by different considerations. There are different considerations that you have to put in place before you can say this is the appropriate method. But widely speaking, or broadly speaking, there are two major methods when you are doing a valuation, particularly from a public entity point of view. You have the absolute valuation models, and then you have the relative valuation. There are other methods, right, that can be subsumed into these different methods, but broadly speaking, you have these two major methods, absolute and then relative. And then under absolute, you have what you call the discounted cash flow, DCF. I believe all of us are familiar with this by now at this point of preparing for the examination. So, but the important thing I would mention here is that when you are talking about DCF, you are picking a particular measure of cash flow to value that company. It's a discounted cash flow. So you have a particular measure of cash flow, which for instance can be dividend. Dividend is a measure of cash flow. It's a cash flow that is given to shareholders, particularly when the shareholder is taking a minority point of view, right? So what you can rely on is dividend as a minority shareholder. Okay, so you use that cash flow to then estimate the value or the expected value of the intrinsic value of that particular stock. You also have company level cash flows where you talk of free cash flow to equity, free cash flow to firm. We'll see more about this as we move on in this boot camp. And then you have your residual income as well. And then you have asset-based model. Then you have relative valuation models where you talk about comparables. There are different values. You have price-based relative valuation models, which include your price to equity ratio, your price to sales ratio, your price to book ratio. I'll just quickly make a point here that price to book is most relevant for banks or financial services companies generally. So you can have a question that says, which of the following is most appropriate for a financial services company or a bank, most importantly? So a price to book ratio is most important or most relevant for financial institution. It's a point, but it's a very important concept for us to know that price to book is most important. That's because the book value, the operations of banks, commercial banks, are typically derived from you can understand their fundamentals mainly from their book value, which is their net book value, right? Their equity value, because that is not as volatile as some of the line items that you have in their income statement. And even the revenues that they get, the major source of the revenue of banks are derived um, from values from their balance sheet. For instance, you talk of interest income. You get interest income from what you've lent out, um, your loans to customers and other banks, which is a balance sheet item. Just saying much of the volatility that you would see or less volatility occurs in the equity value or the book value of banks relative to what you would have in their income statement. So just note that price to book value, or you can read more on that as well later on. Okay, so it says not using more than one model can yield incremental insights. Yes, we can combine different ratios or different methods. So even sometimes you combine different methods under DCF, and then you combine that with some relative valuation estimates as well, where you then talk of a triangulated or a blended approach to valuation. Okay, so sometimes you can combine different methods, but again, using a lot of methods does not necessarily mean that your model is correct, right? It doesn't necessarily mean that your intrinsic value is correct. If you combine like 10 methods, it doesn't mean that that's a superior to somebody that has only used only 2 or 3 models. So it's just saying that yes, using more than one model can yield incremental insights, but it doesn't necessarily mean superiority of insight. Now, the next method or the next valuation process, the fourth one, is converting your forecast to valuation. Now you've done your forecast, then you need to convert those forecasts to valuation. And then there are different things that they want us to know here. You have what you call sum of the parts method. When you do sum of the parts, it means when you have a company that has operations, is maybe a big company, a conglomerate that has operations in different sectors that are not necessarily the same or that are affected by different fundamentals. So maybe you have a company, look at a Dangote, for instance, at the group level, you have cement, you have petroleum now, which of course has not been listed, but will soon be listed. You have that's a refinery. You have sugar, you have flour, you have different Dangote businesses that are affected by different fundamentals. If you want to then value Dangote at a group level, you can do what you call the sum of the parts, where you value the individual businesses and then you sum their valuation. But summing their different valuations to get the group valuation is not that direct. Sometimes we have what we call the conglomerate discount, which is just a discount that you apply when you think that as a group, it is sometimes difficult to manage. I mean, you can have what you call these economies of scale. You can have some disadvantages to being a conglomerate as well. It doesn't mean that it is not good to be a conglomerate, but you can sometimes have some bottlenecks at that level. And then you apply what you call a conglomerate discount. There are different considerations that you can have that can that can inform you applying a conglomerate discount, but it's just an important concept for us to also note that we have. Then the third bullet point here says the method must be consistent with the characteristics of the company. Yes, it is very important that you use the appropriate method based on the characteristics of the company that you are valuing. And also, even within a particular method, there are different parameters that you select. Say, for instance, you have to decide where do you use your weighted average cost of capital work versus where do you use your cost of equity, to do your discounting. Those are very important considerations that we have to be aware of when we are doing valuation. But again, we'll do some examples and see some of these things in more detail. Then the last point here says you apply the valuation conclusions, which means then you're reporting, you distinguish between the facts and your own opinions as the analyst, and then you state the risk factors, you disclose any potential conflict of interest when you are doing your reporting. Okay, these are the 5 steps. As a summary, understand the business, forecast the performance, select the appropriate valuation method, convert those forecasts to evaluation, and then apply the valuation conclusions. Now, let's take some examples, some questions to try and gauge. As we are doing these questions, we might also come across terms that we've not necessarily talked about. So it also helps us to talk about some of those things. Now, the first question on the second slide, let's assume we have different slides here. Zilkin discusses some views about assessing where mispricing can occur. And one of the other things I would just quickly point out is when you see a question, typically at level 2, questions are long, or you have a sort of case study and then you have questions under the case study. Try and quickly know what is important and do away with the noise, right? So quickly sieve out what are they asking me for so that you are not carried away or you are not confused by the long story that the question is saying or the case study is saying. Okay, so here we are talking about mispricing. So I will start reading again. On the second slide, Zilkin discusses some views about assessing where mispricing can occur. We're talking about mispricing. Zilkin states that companies that emphasize the efficient use of assets and employees to reduce costs in all customer segments are more successful than other companies in the same industry that tailor products and marketing to a specific consumer. So you see here is comparing customer segments reduction in costs to those that focus on a particular specific customer segment. With respect to the second slide, which of the following strategies best describes the strategy used by more successful companies? Used by more successful companies. I think the answers are coming in already. So you have focus, you have differentiation, you have cost leadership. So the guy said that companies that emphasize the efficient use of assets and employees to reduce costs are more successful than those that tailor products and marketing to a specific consumer. So focus, differentiation, cost leadership, A, B, C. Which one is our answer? Let me look at the chart. Someone said, okay, this time for, okay, that was on my screen. Okay, cost leadership, C, C, B. Somebody said B. We have C, we have B. So let's go back to the slides. Okay, so A is focus, B is differentiation, C is cost leadership. Now, this guy has said that companies that emphasize the efficient use of assets and employees to reduce costs in all customer segments are more successful. So he's saying cost reduction is more successful, is a more successful strategy. So the answer is C. They are more successful than other companies in the same industry that tailor products and specific. So these other companies are those that use focus as a strategy. Nothing here speaks to differentiation. So the answer is C. The answer is C. Okay. I hope that is clear to the person or the people that thought the answer is B. So nothing speaks to differentiation here. It is cost leadership. Question 2. On the third slide, Zicklin states that another technique for determining mispricing. Please, if anything is not clear, you can just drop a chat that please explain this again so that we are sure that everyone is on the same page. Okay. On the third slide, Zicklin states that another technique for determining mispricing is to solve for revenue growth implicit in the market price and then make a comparison to projected industry revenue growth and the size of the company base. Okay, that's a long one. I'll read it again. It states that another technique for determining mispricing is to solve for revenue growth implicit in the market price and then make a comparison to projected industry revenue growth and the size of the customer base. The analyst can then determine if the company's revenue growth is realistically achievable. So you solve for revenue growth implicit in the market price and then compare that to that of the industry and the size of the customer base. This technique is most likely an example of what? I believe that at this stage, we are already used to most likely, least likely. So we've dealt with that in level 1. This is level 2. So I believe we are all used to that. So to just take note. So they said the technique described in the third slide is most likely an example of what? Sensitivity, solving for a catalyst, inferring a market expectation. Which one is our answer? A, B, or C? A, B, or C? I can't see anything coming into the chat anymore. Oh, okay. Inferring a market expectation, C. Please, those who are putting C, A, B, C, it will be useful to put maybe 2A, 2B so that we are sure we are done with question 1 and when we are in question 2. Okay, so I believe the answers now for question 2. So yes, inferring a market expectation, that is correct because what you are doing is you are looking at, you are comparing the revenue growth that is implicit in the market price, and then you compare that with the projected, when you say projected, that is expectation, the projected industry revenue growth and the size of the customer base. That is correct. C. Question 3. So you can just put 3A, 3B, 3C when you're answering question 3, so we are sure. On the last slide, Zilkin continues with the topic of pairs trading. She mentions that stocks with similar PE ratios within an industry will be grouped for further analysis. So stocks with similar PE will be grouped within an industry. Generally, company level projections for revenue and cost will be compared to group aggregated projections and industry-wide projections to determine above and below average performance. a lot of story again. It's just saying you are comparing PE ratios, and then you are also generally company level projections will be compared to those of the group and the industry. Okay, so this kind of analysis is best described as what? Relative valuation, top-down analysis, sum of the parts valuation. What is that saying? Okay, I say 3A, 3A, 3A. Yes, that is correct. That is correct. That is relative valuation, because what we are doing is to compare a particular metric for a particular firm with that of the industry or a group aggregated projection. That is relative. When we compare with a particular company with that of the industry, that is relative. Okay, moving on. Question 4. The the public market value of a diversified company is lower than its sum of the parts valuation. The public market value of a diversified company is lower than its sum of the parts valuation. The difference best describes a relative valuation, private market value, conglomerate discounts. Okay. So question 4C, conglomerate discounts. Okay, awesome, awesome. So we are ready for this exam. That's beautiful. Conglomerate discount, that is correct. So you have a company's valuation, and then you see that it is lower than the sum of the parts valuation. What would make the difference is most likely conglomerate discounts, because remember they said a diversified company. That is important in answering this question. Okay. Question 5. An analyst's selection of a valuation model should be such that the model is consistent with what? So the valuation model analysts will select should be consistent with what? A, the characteristics of the company, but not the analyst's perspectives. B, the analyst's perspectives, but not the characteristics of the company. C, both the characteristics of the company and the analyst's perspective. So the valuation model you select as an analyst should be consistent with what? Is it just the characteristics of the company? Is it just the analyst's perspective, or is it both the characteristics of the company and the analyst's perspective? Okay. So okay, someone says questions 2 and Ash. I'm not sure. Chinwe, I think so you said questions 2 and Ash seemed alike. Explain. I'm not sure what the second thing is talking about. Could you please just retype that? Okay, so 5C, I see 5A, I see 5C. Okay, question 2 and 3. I'll go back to that once we are done with question 5. So I see 5C, I see 5A. So let's go back to 5 and see what it's saying. So an analyst selection of evaluation method should actually, remember I kept emphasizing the analyst perspective or the analyst's own discretion. It is also very important when you are selecting a valuation method. Anything you are doing under valuation, there's no way you can take out the analyst's perspective or its discretion. That is why one of the things that you do is to here, you see the last method, applying the valuation models, it says you should distinguish between facts and opinions. Distinguish between facts and opinions. There are facts. There are also your opinions as an analyst. You can't do away with your opinions. So the analyst's perspective is very important. It's as important as the characteristics of the company. So the right answer is C. It is both the characteristics of the company and the analyst's perspective. Okay, so let's see what Chinwe was saying. It said 2 and 3 look alike. Let me see what that says again. It says questions 2 and 3 seemed alike. Okay, so let's look at that, what each of them is saying. So what 2 is saying is you are comparing. So let's read it again. Zipkin states that another technique for determining mispricing is to solve for revenue growth implicit in the market price. You have a market price, and then you are looking at what is the revenue growth implicit in this market price, and then make a comparison to projected industry revenue growth and the size of the customer base. The what you have here, you are comparing. So the first thing is there's a mispricing, or you want to determine a mispricing in revenue growth, which is implicit in the market price. So you have a market price, you have what is the revenue growth in this market, implicit in this market price. You are comparing that to projected industry revenue growth, and the size of the customer base. Okay, I think I see what you mean by they look similar. The important thing for this first one is you most likely are under the same company. So yes, you have projected industry revenue growth, and then you have the size of the customer base of the particular company. Now, the analyst can then determine if the company's revenue growth is realistically achievable. Okay. Um, so I see your point of view that inferring a market expectation here and then some of the or relative valuation. In question two, they are not asking us for a valuation method. What they are asking us for is you are trying to determine a mispricing, and then you are saying use this technique where you are comparing the implicit revenue growth with projected industry revenue growth and the size of the customer base. You have a revenue growth that's into the future. You have projected industry revenue growth as well, and then you have size of the customer base. If they were asking for the method for valuation, yes, you could say that it's more or less relative valuation, but even at that, it's still not relative valuation because you don't use revenue growth as a method for valuation, right? You have your methods, you have your PE, you have your PS, price to sales ratio, but not necessarily the growth rate of the revenue. What you are trying to do here is looking at the options. Are you doing a sensitivity analysis? Are you solving for a catalyst? When you say sensitivity analysis, you are changing a particular parameter to see the effect of that on the result of your valuation. That is not what you are doing. You're not changing parameters. You are comparing the implicit revenue growth with that of the industry and the size of the customer base. And then when you come to question three, what you are doing is also a comparison, but what are you comparing? You are comparing the PE ratio of a particular company with that of the industry. So it says she mentions that stocks with similar PE ratios within an industry will be grouped for further analysis. So you are grouping companies with similar PE ratios within the same industry. And then it says generally company level projections for revenue and cost will be compared to group aggregated projections and industry-wide projections to determine above and below average performance. Yes, they sound alike, but in the first one, what you are doing, what they are asking us for is not necessarily the valuation method, it's just a technique. What are you trying to do there? And then in question three, what is the valuation method that you are using? So it's about maybe mostly, the difference is mostly about what the question is even asking us than what we are trying to do. So the question two is trying to just say, is the kind of technique we are using? Question three is asking for the valuation method. I guess that's where the bulk of the differences in question two and question three than what exactly we are trying to do. I hope that helps. Okay. So I think the next one is question six. Yes, we've done question five. Question six. Six says Company A is an employment services firm with no debts and has fixed assets consisting primarily of computers, servers, and commercially available software. Okay, it's an employment services firm with zero debt and has fixed assets consisting primarily of computers, servers, and commercially available software. Many of the assets are intangible, including human capital. So you see, you need to understand the characteristic of this company. They say it's an employment services firm. It has no debt. Its fixed assets are mainly computer servers and commercially available softwares. And then many of its assets are intangible, including human capital. Those are important things in understanding the characteristics of the company. The company has a history of occasionally paying a special cash dividend. Occasionally, which means this is not regular. And it's not even a dividend, ordinary dividend. So you have special cash dividend. Now, based on company A's characteristics, which of the following absolute valuation models is most appropriate for valuing that company? So which of the methods is most appropriate? So you have asset-based, you have dividend discounts, you have free cash flow to the firm. Okay, what are our answers? Okay, I see 6C, 6C, 6C. Okay, so let's go back to it. So based on the characteristics, yes, 6C is correct. Free cash flow to the firm. And why is that so? We cannot use asset base because see, many of the assets are intangible. It is it's a very difficult task to value intangible assets, including human capital. How do you want to value human capital? Yes, there are valuation models coming up today about how to value human capital, but it is still something that is not yet mainstream. And because many of these assets are intangible, it is not appropriate to use asset-based. Now, dividend discount model, we can't use this. It's not appropriate because the company doesn't pay regular dividend. It only pays dividends occasionally, and what it also pays are special dividend. So dividend discount is not appropriate. Free cash flow to the firm is the most appropriate, for valuing this company. Okay. Question 7. Company B operates in three unrelated industries with differing rates of growth. Tobacco is 60% of its earnings, shipbuilding 30% of its earnings, aerospace consulting is 10% of its earnings. The company pays a regular dividend that is solely derived from the earnings produced by the tobacco division. Okay, it pays a regular dividend solely derived from the tobacco division's earnings. Now, based on company B's characteristics, which of the following valuation models is most appropriate for valuing that company? It's a conglomerate in three different industries with different growth rates, and the dividend is regular, although it comes from the tobacco division. So what is the most appropriate method? Asset-based, sum of the parts, dividend discounts. What is our answer to question 7? Okay, so 7B, 7B, 7B. It says, please reconfirm the answer to 5. Okay, I think someone has answered. 5 is C, both the characteristics of the company and the analyst perspective. Okay, and then I see 7B. 7B is correct. 7B is correct. Okay, so because you have different industries, different companies in different unrelated industries, and you also have dividend that comes only from a particular division. So we can't use dividend discounts in this, or it is not the most appropriate rather. Let's say it is not the most appropriate. Okay, asset-based, there's no reason for us to use asset-based here. I mean, we could use it, but the question is the most appropriate. The most appropriate is the sum of the parts because you have 60% from tobacco, you have 30%, which is also significant. You also have 10% from another business, which is actually consulting. Consulting is, you can't use asset-based for that. So the most appropriate is sum of the parts. That is correct. Question 8. Question 8. Let me just check that there's no other question or anything for us to note. Okay. Question 8. Company B has finalized the terms to acquire 70% of the outstanding shares of Company X. So you have Company B that wants to acquire 70% of the outstanding shares of Company X, an actively traded tobacco company in an all-stock deal. An all-stock deal. Okay. Now, which of the following is the most likely to be appropriate to consider in Company B's valuation of Company X? Company B wants to buy 70% of company X, which is an actively traded, we need to take note of that, actively traded tobacco company. Which of the following is most likely to be appropriate to consider in company B's valuation of company X? Is it blockage factor? Is it control premium? Is it lack of marketability discount? What is the answer to question 8? Okay, I see 8B, B, B, B. Okay, seems everybody agrees on 8B, which is control premium. That is correct. That is correct. You can't say lack of marketability discount because it's an actively traded company. You can't say blockage factor because you are literally acquiring the majority of the shares. So who is there to block you? Which majority shareholder is there to block you? So what is important here is control premium, because with 70% shareholding, you would have control. So you need to consider your control premium in valuing company X. Now, question 9. Goldsman explains that spas and personal service businesses are usually valued using a multiple of gross revenue model. A multiple of gross revenue model. He makes the following note for his file. Due to the competitive strategies of the two chains, I will be able to apply a higher multiple than the industry average to value both businesses. So spas and personal service businesses, it says, due to the competitive strategies of the value chains, I will be able to apply a higher multiple than the industry average to value both businesses. The model Gottman suggests for valuing spas and personal service businesses is described as what? Best described as what? Income model, relative valuation, or absolute valuation? Income, relative, absolute. Okay, what are we saying? Okay, 9B, relative valuation. Okay, that is correct because you are using a higher multiple than the industry. So essentially, you are saying I'm comparing the multiple with that of the industry. So I will choose to use higher multiple than the industry based on the competitive strategies. That is relative. That's correct. Thank you. And the last question on this particular topic for us to solve together. An investor implements a peers strategy that she expects to benefit in any market condition. The most appropriate valuation model to use to identify peers is what? What is the most appropriate valuation method to identify peers? Is it relative? Is it asset-based? Is it free cash flow to the firm? Okay. What is our answer to question 10? 10A, 10A. Okay, it says please explain the options. Um, is this for question 9 or 10, please? Question 9. Okay, I'll go back to that. I'll go back to question 9. So question 10 first is yes, A is correct because you are using pairs. You are using pairs. So A is correct. Now let's go back to question 9. Says please explain the options. Now, income model is essentially your your discounted cash flow model, right? Which is a subset of your absolute valuation model. So A and C are almost saying the same thing in terms of options. So when you say income model of valuation, you are using a source of income. Dividend is a source of income to shareholders. So when you use that as a valuation model, then you are under the realm of absolute valuation model, okay, which is option C. Now, the question says that, so Goldman explains that past and personal businesses are usually valued using a multiple of gross revenue model. It makes the following notes in its file. Due to the competitive strategies of the two chains, I will be able to apply a higher multiple than the industry average to value both businesses. What you are doing, or what this guy, God's man, is doing, is using is using a multiple. When you talk about multiples, remember under when we talked about the valuation models, the third method here, you have relative valuation or comparables. Whenever you are talking about multiples, you are in the world of relative valuation or comparables. So multiples include your price to earnings, price to book, price to sales. You have EV, that's EV to EBITDA, enterprise value to EBITDA method. You have different multiples. Now, whenever you talk about multiples, that is relative valuation. That is relative valuation. So what he is doing here, it says it will apply a higher multiple. Okay, let me quickly say something about multiples, or in case, let me check the time to just see how well we are doing on time. Oh, we have almost used 1 hour already. So under multiples, right? Let me quickly say something that the higher the multiple for a particular company, the more you say the company is overvalued. So higher multiple means a company, the stock is overvalued. So for instance, if you are comparing two companies, let's go back to GTCO, you are comparing GTCO and Zenith Bank. Let's say that the PE ratio, the price to earnings ratio of GTCO is 4 times, and that of Zenith is 3 times. That of GTCO is 4 times, that of Zenith is 3 times. A company with a higher multiple is seen as being overvalued. That's a likely exam question as well. So they can give you a scenario where one company has a higher multiple than the other. You say that company that has the higher multiple is relatively overvalued, relatively overvalued. Okay. So while the one that has a lower multiple is relatively undervalued, what that means is your advice should be that investors should sell that one that has a higher multiple, and they should buy that one that has a lower multiple. Now, what Goldsman is then saying in question 9 is that he wants to apply a higher multiple than the industry average to value both businesses. Why would you use a higher multiple to value a particular company? It is when you believe that the company has some advantages that over its competitors, over the industry. So that is what he's saying here, that due to the competitive strategies of the two chains, I will be able to apply a higher multiple than the industry. So if you believe that a company has a competitive advantage over its peers in the industry, then you should be using a higher multiple. But again, if you are just looking at the current multiples of different companies and you have one that has a higher multiple than the other, you say that one that has a higher multiple is relatively overvalued. So there you are talking about relative valuation. I hope that's clear to Uz. Is it Uz? TY says, can you explain question 4, please? Sure. Question 4 says, the public market value of a diversified company is lower than its sum of the parts. Okay, so let's look at it this way. Let's go back to this question. Where's that question about tobacco? Question 7. Let's use question 7 as an example. So you have a company that has businesses in 3 industries: tobacco, shipbuilding, and aerospace. Let's say, for instance, I'm just writing, you might also just write, so tobacco BT, shipbuilding S, and aerospace A. Let's say after all is said and done, the value that you've estimated for tobacco for each share is 100 naira per share. For the shipbuilding, because you have to value them, you are valuing them separately because they have different characteristics in terms of what affects each of these businesses. So for the shipbuilding, your value is 50, and for the aerospace, your value is 20. Okay, for the shipbuilding 50, for the aerospace 20, for tobacco 100. Now, if you want to do some of the parts, all you need to do is to sum up all these three, and then your estimate of value is 170 for company B, the conglomerate. Now, if you then compare this 170 and say, okay, this conglomerate is currently trading at only 159 naira per share. your value is 170. The current market price is 159. That is what question 4 is asking us. So they said the public market value in this instance, the public market value is 159 of this diversified company is lower than its sum of the parts valuation, which in our example is 170. They said this difference between 170 and 159 best describes what? Because this company is publicly traded, that's one, is a public market value. Second, and most importantly, it is a diversified company. It is a diversified company. So when you have a diversified company whose public market value is lower than its sum of the parts, the difference is most likely due to conglomerate discount. You can't say relative valuation here because there's nothing you are comparing. You are not comparing this company with its industry peers. You can't say private market value because you are not, it is not a private market, privately traded stock. The question says the public market value. So it's a publicly traded stock. So the only option, which is actually the correct answer, is a conglomerate discount because we are told that the public market value is lower than the sum of the parts. I hope that is clear to TY and any other one who might have question on that. Okay, that's on that particular topic. So moving on to discounted dividend valuation quickly. We have just about 30 minutes more. Okay, so DDM. Again, when should you use these different methods? So we said we have different valuation methods and there are criteria for you to know when to use a particular method. I think this is also one of the things that is highly testable to say, they give you a scenario that this is the characteristics of the company, as we've seen in some of the questions we've done before, we've just done now. And then they say, based on these characteristics, what is the most appropriate method to value this company? When should you use DDM? When the company is paying dividend and the analyst has a dividend record to analyze. So you have historical dividends. The company has always paid dividend. And most importantly, second point, the board of directors has established a dividend policy that bears an understandable and consistent relationship to the company's profitability. A lot of story. Simplified is that you have a dividend history. You know that the board has said will continue to pay dividend, at least by their policy. They've said they will continue to pay dividend, and that dividend policy is consistent with the company's profitability. So if they say, for instance, we'll pay 70% of our EPS, earnings per share, as dividend, you have a dividend payout ratio that you can use. Or if moments where earnings increases, dividends increase, moments where EPS or your dividend is a constant value. They say within the next 5 years, we are going to pay X amounts as dividend, and after that, we are going to grow our dividend consistently by maybe a minimum of 10%. That kind of thing. You have a way of knowing or estimating how much dividend is likely to be, which is consistent with the company's profitability. That is when you use the DM. And then the investor takes a non-control perspective. When an investor is taking a controlled perspective, DDM is not appropriate. When you are taking a controlled perspective, DDM is not appropriate. But when you are taking a non-controlled perspective, and then these other two criteria are also met, then you should use DDM. When should you use free cash flow, whether FCFF or FCFE? When the company does not pay dividend, FCFE can be appropriate. When the company, even if the company pays dividend, but dividends significantly exceed or fall short of FCFE, then you should use FCFE. So what this is saying is, even though a company is paying dividend, the fact that a company is paying dividend is not the only reason to say yes, DDM is what we should use. You should use FCF, free cash flow method, even when a company is paying dividend, but dividends are not consistent with the free cash flow to equity. So they significantly exceed or fall short of FCFE. Then you should use a free cash flow method. The company's free cash flows align with the company's profitability. within a forecast horizon. We can read all of this, the slides will be shared. And then when a company does not take a control perspective, you use FCFA. So you see the difference between DDM and FCF method. It's a very important thing for us to note. When should we use DDM? When should we use free cash flow? So remember, even the fact that a company is paying dividend is not the only reason why you should use DDM. A company can be paying dividend, but it might still be appropriate to use FCFE, especially if the company is paying dividend, but the investor is taking a controlled perspective, then you should use free cash flow method. If the company is paying dividend, but dividend is not consistent with free cash flow to equity, you should use FCF method. So please watch out for that. So don't just see the company is dividend paying and then you say, oh, dividend discount model is the answer. No, you have to look for other criteria within the question or the scenario that you are given. The residual income method, you use this when the company doesn't pay dividends, and an alternative to free cash flow model. So when the company doesn't pay dividend, you can use residual income. When the company's expected free cash flows are negative within the analyst comfortable horizon, forecast horizon. So if you have negative free cash flows, then you should use residual income. Okay. The dividend discount model, for a single holding period and for multiple holding period, you have you have when you are doing your estimate of value, you have two things that you are considering. You are considering the future price of the stock, and you're also considering the dividends that you are expecting from that stock. The expected price. So if you are doing a value but for December 2026, for instance, that is how much do I think GTCO is going to be worth? What's the value of GTCO by December 2026? Remember, valuation is a forward-looking approach, is an estimate of future value. Okay, so the first thing I'm considering is what do I think the price would be by that time, by that December, maybe December 31, and then what is the dividend I'm expecting on that date that will be paid by the company by December 31st, 2026. Those are the two elements to consider. So if you are doing a single holding period, you just add up both the price and the expected dividend. You see D1 here means in the future, in the next future. And then P1 is the price as well in the foreseeable, the first period that I'm considering. And then you discount both of them to today, which is why you have V subscript 0. I believe we are all used to this by now. And then when you are doing dividend discount model, remember dividend is a cash flow to who? Is it to the firm? Or who earns dividend? Maybe that's the question I should ask. You see, it is equity shareholders that earn dividend. So it then means that your measure of discount rate here, your R here, will be your required rate of return on the stock. Or you can also have it as your cost of equity. So your discount rate is very important. When you are doing a DDM, you have to note that your DDM, so when you are doing DDM and FCFE, please take note, DDM, FCFE, free cash flow to equity. Any cash flow you are using that is attributable to only equity shareholders, your appropriate discount rate, your appropriate R will be your required return on the stock, or you can say your cost of equity, because the cash flow you are using that you are discounting is the cash flow that goes to equity shareholders. But when you are doing FCFF, which is free cash flow to firm is attributable to both equity shareholders and debt providers. So in that instance, what you'll be using as your discount rate would be your weighted average cost of capital. Your weighted average cost of capital. I'll take that again because that's something for us to note. You can see a question that you have different discount rates. You are then confused. Which one should I use? Should I use return on equity or my cost of equity, or should I use my WACC? When your measure of cash flow is a cash flow that is attributable to equity shareholders only. So, for instance, your DDM and your FCFE, free cash flow to equity, your discount rate there would be your cost of equity. or they can call it your required return to equity. However, when you are looking at FCFF or any other cash flow that is attributable to all providers of capital, both equity and debt, then you'll be using your weighted average cost of capital. Okay. Then when you have your multiple holding period under DDM, what you are just doing is you are adding your different measures of expected return. So dividend in the first period will be discounted by the required return in the first period. Dividend expected in second period in year two will be discounted. You raise it by power of two, and then you add the price in the second period. So you can then do D1 over 1 plus R raised to power 1 plus D2 plus P2 raised to power 1 plus R raised to power 2, just to know how to do the discounting. When should you raise to power 1? When should you raise to power 2 or power 3, and so on and so forth. So you use the appropriate year number as your subscript or superscript, rather. What's this one now? The power. Okay, so let's look at this example. Suppose that you expect company A to pay a 4 naira 60 kobo dividend next year. You expect the price of the stock to be 53 in 1 year. The required rate of return for company A stock is 8%. What is your estimate of the value of the stock? Okay, can we quickly do that? I know my talking can also get in the eye, so I'll keep quiet for 1 minute for us to quickly do that. Okay, let me check the charts and see the responses. Okay. Oh, so there's a question. Let me just scroll a bit. So Papa Tokwe says, if it is paying dividend constantly, but there is going to be a takeover with the expectations of dividend payout ratio changing, okay? Which model okay. So the company pays dividend constantly, but there is going to be a takeover with the expectations of dividend payout ratio changing. Which model should we use? We can still use DDM here. So this is where your multi-period dividend DDM comes in. So if you know that in this particular period, this is the dividend payout ratio. Maybe takeover will happen in 5 years, and you expect maybe payout ratio would increase from, maybe let's say it's currently 30%. You're expecting it to increase to 40%. Then if that's the expectation, you can model that into your data as well, and get your estimate of your value. So you can still use a DDM. You just use the appropriate payout ratio into the future that you expect. At least if you expect it to still be consistent, it's just that it will increase and stay maybe at 40%, then you can still use that. Please, do we ever have to use ROE to discount? Do we ever have to use ROE? We don't use ROE to discount. We use it when you are calculating your justified PE, for instance. You can use ROE as from in your numerator. You don't use the discounts, right? But yes, you use it to do your justified P, for instance. What you use to discount is the required return. So the return on equity is more like, this is the calculation, but return on equity can be different from your required return. So from that perspective, it is better to use required return than ROE. So I see everybody got 53.3. So I have an Excel file which I would also share with everyone later, where I've just tried to do some of those. And so, yes, most likely the difference is just in what's it called now, in rounding off. Okay, but yeah, I think that's correct. So what you do, you say your dividend, expected dividend, which is J4, plus your expected price in year one, then you divide that by 1 plus the required return, which is 8%, and it gives us 53.24. Okay, so if you have 53.3, I would think that that is just because of rounding error. All right. That's good. Thank you. Now, Gordon growth model. I think this is also something very important for us to know. So what it assumes is that dividends grow indefinitely at a constant rate. So the Gordon growth model assumes that dividend grows indefinitely at a constant rate G. And it leads to a simple formula for doing our valuation under DDM, right? So here, I've just tried to show some important relationships that we should note. When we have dividend growing at a constant rate, what we can do to get dividend today, the dividend today will be dividend yesterday multiplied by 1 plus G. DT is saying dividend at a particular point in time. DT minus 1, the previous period. So that's what I'm saying today and then yesterday. Okay. So it then means dividend tomorrow. If you want to do DT plus 1, it will be DT today and then you grow it by that same growth rate. Okay. And then your estimate of value in that instance would then be what you've been doing before. Just to simplify it, at the end of the day, what you have is DO multiplied by 1 plus G divided by R minus G. What's this saying? It's saying the value today is the dividend today, which would grow by the constant dividend growth rate, G, and then we divide it by the required return minus the growth rate, or the cost of equity minus the growth rate, okay, which is then the same. I mean, just some mathematical manipulations. You have your value then being equal to the dividend tomorrow. Your DO times 1 plus G is your dividend tomorrow, right? So dividend tomorrow divided by R minus G. Okay, very important formula or identity for us to note. For fixed rate perpetual preferred stock with constant dividend. So if you have a fixed rate perpetual preferred stock with constant dividend, D, then your estimate of value would then be equal to D over G. D over R, excuse me, D over R. Remember why it is just D over R. This formula, I hope you can see my cursor. This formula is the same thing as this formula. The difference is that you have a constant growth rate. Fixed rate perpetual is a fixed rate perpetual stock, which means you don't have a growth rate. You don't have a growth rate. It's a fixed rate perpetual preferred stock with a constant dividend. So dividend is constant. It means dividend is not growing. Then your G is 0. So it then means you can rewrite as D over R minus G. G is 0. It's something as D over R. Okay. So that's what the point here is saying. It says formula is the same as the one the arrow is pointing to, but G is 0 since dividend is constant. GGM can also be applied in cases where G is negative. Yes. So we can have cases where the growth rate is negative. We can also apply GGM in those instances. Please note that you can have a question that says, when is GGM appropriate or when is it not appropriate? And then you see an option that says that when growth rate is negative, you cannot apply GGM. No, you can apply GGM even when G is negative. Then what would then happen is just that your denominator will be R minus your negative G, which would then be R plus G, since you'll be multiplying negative with negative, okay? So that's very important to note. Okay, and then we have free cash flow valuation. Free cash flow valuation. I think that what is important here is how do you calculate free cash flow to firm? I've emphasized before that when you are using your free cash flow to firm, any cash flow that is attributable to all providers of capital, such as FCFF, your discount rate is your WACC, your weighted average cost of capital. Then the next question is, how do you calculate your WACC? You can see it here. Your WACC is your weight of debt multiplied by the after-tax return on debt plus after-tax cost of debt, excuse me, after-tax cost of debt plus your weight of equity times the cost of equity. I believe that by now all of us are familiar with that. So I would skip the explanations. And then these other identities, please just note them. Again, the slides will be shared, just note them. Then when you come to, if FCFF grows at a constant rate G, then your formula becomes FCFF divided by WACC minus G, which is similar to what you have under DDM, right? So you see what you have here. If you have a constant growth rate under your Gordon growth rate, you have D1 over R minus G, D1 over R minus G. Same thing you have here. So the difference is what you have is FCFF over R minus G, but your R here is not just R, it is your WACC. So it's more or less the same thing. It's just your measure of cash flow is different. So your measure of discount rate is also going to be different. But in terms of fundamentals, the identities or the formulas are very similar. You have the same thing with the FCFE, just that your discount rate here is now your cost of equity. Okay. So those are the differences that we need to note. And then if you've done your free cash flow to firm, and then you want to get your equity value from there. So your equity value is your firm value minus the market value of debt. Your equity value is your firm value minus market value of debt. That is very important to also take note of. Okay. Now, let's quickly solve some questions and maybe I think that's where we'll be able to end it. So we have 6 questions here. Question 1, whatever their name is, Shimosuk has FCFF of 1.7 billion Japanese yen and FCFE of 1.3 billion. Okay, FCFF is 1.7 Japanese yen, FCFE is 1.3 billion. Their WACC is 11%, required rate of return is 13%. FCFF is expected to grow forever at 7%, so you have a constant growth rate, and FCFE its growth rate is 7.5%. They have an outstanding debt of 15 billion. Okay, lots of numbers. The first question is asking us for the equity value using the FCFF valuation approach. The equity value using the FCFF valuation approach. So we need to first calculate the firm value and then we subtract the debt, market value of debt to get the equity. So I would quickly take a 1 minute pause for us to do. So we can quickly do questions 1 and 2. They are based on the same case study. Okay, what do we have? So one, okay, I say we have just a few answers. 1.3 billion as question 1. Oh, sorry, 30.475, 30.7, okay. 9.28 billion. Okay. Okay, because of time, let's quickly look at them together. Again, I've prepared the answers here. So this is question 1. We were told that FCFF is 1.7 billion. Okay. The growth rate is 7% for FCFF. Remember, they said that the FCFF is expected to grow forever at 7%. So we need to be careful with what we pick. So the growth rate for FCFF is 7%. WACC, we were told WACC is 11%. So the firm value is simply our FCFF multiplied by plus the growth rate. So you have to grow your FCFF. You multiply it by 1 plus growth rate, and then you divide your answer by WACC minus the same growth rate. So your FCFF multiplied by 1 plus growth rate divided by the WACC divided by WACC minus growth rate. So that gives us 45.48. I'm not sure if anybody got that answer. 45 points. So most likely Zainab and Nwaneka, maybe you've picked the wrong variables. So that's the answer. Kende, you said no. I'm not sure what the no is for. Oh, maybe you meant number 2. Okay, number 2. Chinwe said you didn't discount. I don't know if that's for me or for. You said we should calculate for value of equity. Oh, okay. Sorry. Yes. Oh, sorry. We're not done. Oh, yeah. Okay. Yeah. This is a firm value, and then we have the debts. And then when we subtract the debts, we have 30.48. The equity value is 30.48. Yes, that is. So if you have 30.48, then that is correct as question 1. Yes. Thank you. Thank you. Yes. Then the second question says, what is the total value of the of this Shimo Suk equity using the FCFE approach? Using the FCFE approach now. So the first one is FCFF approach. So for FCFF approach, we first calculate the firm value, which is 45, and then we subtract debts, which then gives us equity value, our final answer of 30.48 billion. Okay. So now using the FCFE, what did we get? Let me go back to the page so that we can see the question in case we need to pick the variables. So question 2 now, using FCFE valuation approach. All right, so again, because of time, yes, 5 minutes to go. Thank you, Gloria. So because of time, let's quickly look at question 2 together. So we are told that FCFE is 1.3. We have a growth rate of 7.5. We have a cost of equity of 13%. So we just apply similar formula, just picking the correct variables. So we have equity value multiplied by 1 plus the growth rate, and then we discount it with our R minus G. So you have FCFE times 1 plus G, then divided by R minus G. That gives us 25.41. I think, yes, some people got that 25.41. That's correct. Okay, thank you. Question 3. Question 3. So from this whole noise of long information, want us to calculate the WACC. So can we just pick the right variables and calculate WACC? Okay, we have 4 minutes left, so I won't be able to wait anymore. So I will just show us from the Excel file, the WACC. Sorry, from the Excel file. So you calculate WACC simply. So you have your weight of debt, you have your weight of equity, you have your return on equity, you have your return on debt. So, but our rate of, our cost of equity is 10.5. And how did we get that as well? We are given the different parameters. So again, I'll send this Excel file so we can see how all these things come together. We have a risk-free rate, we have a beta, and then we have the risk-free rate. So a risk-free rate of 5.5, you have beta of 0.9. So you know how to use your CAPM formula. So your risk-free rate plus your beta multiplied by your risk rate or your market premium actually. So if you don't have a market premium, or if that's not given, that's why we just use that. But yes, you calculate your cost of equity, and then your cost of debt has to also be the after-tax cost of debt. So we are told that we have a cost of debt of 7% before tax, and then we have a 40% tax rate. So you have to say your 7% multiplied by 1 minus your tax rate. That gives you your after-tax cost of debt. And your WACC is simply then your weight of debt multiplied by after-tax cost of debt plus your weight of equity multiplied by the cost of equity. That gives us 8.89% for this particular question. And then question 4 says that we should calculate the value of the firm. The value of the firm. Again, we have different parameters given. Based on those parameters, we have FCFF as 1.1559, and then we have a growth rate for FCFF at 4%. So the firm value is simply your FCFF, again, similar to what we did before in question 1. You grow that by your growth rates, and then you say divide it by your WACC minus your growth rate. Okay, that is the firm value. So firm value. Question 5 then says to calculate the equity value. So equity value is simply firm value minus the market value of debt. That gives us equity value. And lastly, on this question, we'll have to calculate the value per share. So the value per share is simply our equity value divided by the number of shares outstanding. Number of shares outstanding. Let me just see the chart in case there's anything that is not clear. So we have less than 2 minutes left, so we can quickly. So again, I will share both files. Oh, you can see the Excel file. Is it only in Nwanika or everybody can see my Excel file? Okay, let me quickly stop sharing and reshare just in 1 minute. Sorry, I didn't realize nobody could see my Excel file. Please, can you see it now?
Yes.
Okay. Oh, sorry. I didn't realize you couldn't see it earlier. Anyway, I'm going to share this Excel file. So I've just been talking to myself since. Sorry about that. Okay, but you have all the exercises, the answers here, all the things I was explaining about how to calculate your cost of equity. The formula is there, the cost of debt, after tax cost of debt, and then your WACC. You see the variables that are being picked and all of that. So up until how we got the value per share, everything is there. Okay, so I think I have to stop at this point because of time, so, but you'll get both files. Thank you very much, everyone, and I wish you absolute success. Cheers.
Thank you so much, Damilare. Thank you very much. We appreciate you. The society appreciates you. So that will be all for the morning session. We are going to take a very short 15 minutes break so everyone can stretch themselves, ease themselves, get water, and just refresh a bit before we continue with the afternoon session. So it's a 15 minutes break, a very short one, because we do want to cover a lot of grounds. The next class is going to start at 12:45 p.m. That's quantitative methods, 12:45 p.m. to 2:15. So it's about 1 hour, 50 minutes. Yeah. So but the Zoom is going to keep running. We'll just go on mute, and once it is like a minute or two to 12:45 p.m., you will hear the next facilitator come up to set up. So yeah, see you shortly. Also, just like Damilare mentioned, all the documents, the materials, the Excel, the slides will definitely be shared by email to everybody on this call and those registered but couldn't make it, including the recording of this session.
Professionals, we are impact-driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force